Hello friends, I am Professor Nihit Jhaveri welcoming you on behalf of JK Shah classes. Today we will be revising PGBP chapter part 2. Part 1 is already done. We are done till section 35E. Now proceeding further with section 36.1. Section 36.1 has 20 expenditures for which deduction is allowable. Section 36.1 various subclauses, subclause 1, subclause 1A and subclause 1B, all three combined together. All three are with regards to deduction with regards to insurance premium. Which kind of insurance premium? Subclause 1, insurance premium for stocks or stores. Stocks and stores as in raw material, consumables, finished goods, opening stock, closing stock, finished goods, everything. Even work in progress. Second is insurance premium on the lives of cattle. But cattles are owned by members who are members of primary milk cooperative society, and the premium is paid by Federal Milk Cooperative Society. So this is unimportant, but let's still try to understand. So what happens is there are cattle. Cattles are owned by members. There is a primary milk cooperative society which has got around 50 members each. And there are multiple primary cooperative milk producer society, 1, 2, 3. That way there are 50 primary societies which are members of Federal Milk Cooperative Society. So Federal Milk Cooperative Society will have 50 members, and members would be some primary society, and primary society will have 50 individuals as members. Cattles are owned by members, but members are not paying premium. If members pay the premium on the lives of cattle, members will get deduction, but members are not paying. Even primary society is also not paying, for which member is a member. It is paid by Federal Milk Cooperative Society. So someone else is paying premium on the lives of cattle owned by somebody else. So that Federal Milk Cooperative Society will get the deduction under 36.1 clause 1A, unimportant. And last one, slightly important, 36.1 clause 1B, insurance premium, but here it is health insurance premium. Premium paid by employer on the health of employees, provided it is paid by any mode other than by cash. Same condition is there under section 80D, where employee himself makes payment. If you are an employee, you yourself pay for your mediclaim, you will get deduction under 80D, provided paid by other than cash. And in case your employer pays, employer will get the deduction, provided paid by any mode other than by cash. 3 are done out of 20. Fourth one is bonus or commission to employees. 36.1 clause 2, bonus commission to employees subject to 43B. 43B means payment should have been made actually on or before the due date of filing IT return. Otherwise, deduction will be allowed later on whenever payment is made. So bonus commission to employee, deduction will be allowed only on payment basis. Third one is very important, interest on borrowed capital, section 36 subsection 1 clause 3, provided it is interest on borrowed capital, fund should have been borrowed. Without borrowing, if you are paying interest to somebody, for example, interest on delayed payment, you were to make payment to somebody, you did not make payment on time, so you were being charged interest. That interest will be allowed, but under section 37.1, generally allowable deduction, not under section 36.1 clause 3. Under 36.1.3, fund should have been borrowed by you. Okay, interest on borrowed capital, provided the funds are used for business profession. Funds should have been used not for personal purpose. If the funds are used for acquiring house property, then interest will be allowed as a deduction under the head house property. If the funds are utilized to acquire some securities, shares, debentures, whereby income is taxable under IFOS, then interest will also be allowed as a deduction under IFOS to the extent allowable. Here, deduction of interest will be allowed under this head only when funds are used for business profession. Subject to 48.2, that is excess payment to relative or substantial interest holder. For subject to 48.3, that is cash payment of interest exceeding 10,000 in one single day to one single person, otherwise by way of account payee check, account payee draft, ECS, etc. Subject to 43B, when interest is payable to scheduled bank, public financial institution, state financial institution, cooperative bank, then interest should have been paid on or before the due date of filing IT return. Otherwise, deduction will later on be allowed whenever it is actually paid. Subject to TDS under section 193, that is interest on securities, or 194A, interest other than interest on securities. 194LB, interest payable by infrastructure debt fund. 194LBA, interest payable by business trust, interest payable by investment fund, interest payable by securitization trust. LBA, LBB, LBC, BIS, business trust, investment fund, securitization trust. 194LC, all these sections are part of TDS chapter, and some of them we discussed in chapter 12 also, special rates of tax. Some of them we discussed, or all of them we discussed in TDS chapter for sure, but we discussed some of them in special rates of tax chapter also. 194 LC, if you recollect, interest payable by Reliance Industry to Bank of China, that is Indian company or business trust paying interest to foreign company or any entity outside India, provided funds were borrowed in foreign currency. 194 LD, interest payable to FII or QFI, and 195, interest payable to any non-resident or a foreign company which is not covered by earlier sections. Okay, now interest on income tax, interest on late payment of income tax will not be allowed as a deduction. Income tax itself is disallowed under section 40 clause A subclause 2. Income tax is disallowed, and there are various supporting case laws, and it's a very well acceptable position of law that interest on income tax will also be considered at par with interest on income tax will be considered at par with income tax itself. So whatever is the treatment for income tax, same will be the treatment for interest also. So interest on income tax we are not talking about. Here we are strictly talking about interest on capital which is borrowed. 36(1)(3)(a), which is totally unimportant. Discount on zero coupon bonds. Zero coupon bonds is defined in section 2 clause 48. Zero coupon bonds discount, that is 1000 rupees of face value, will be allotted at a highly discounted rate. You know the system of zero coupon bonds. 1000 rupee face value allotted or issue price will be 200 rupees, 80% discount. That 80% discount, that is 800 rupees, from the payer perspective it will be called as a discount, and from the recipient's perspective, bondholder perspective, it will be capital gain. For payer perspective, the company which has issued zero coupon bond, for them whatever discount they have offered will be allowed in equal installments spread over the tenure of the bond, starting with the date of issue of bonds till the date of maturity of bonds. Here calculation is to be made from date to date and not from year to year. 36(1)(4), 4A, 5, 5A, these four are important from exam perspective. These are in connection with employer-employee. So first one is 36(1) clause 4, employer's contribution to employees' recognized provident fund. Recognized provident fund or approved superannuation fund, subject to 43B. 43B says that if employer contributes to these accounts, employer's own contribution. There are two types of contribution, employer's own contribution and second is employee's contribution, which is routed through employer. Employer's own contribution, employer will get deduction only when employer actually deposits on or before the due date of filing IT return. Again, these two accounts, provident fund account or superannuation fund account, should be either recognized or should be approved. Then only deduction will be allowed. As per 40A subsection 9, which we will discuss in some time, if the contribution is to unrecognized provident fund or unapproved superannuation fund, then deduction will not be allowed. Then 36(1) clause 4A, employer, again employer's contribution. Mind you, it is employer's contribution to employees' pension scheme. Pension scheme means which pension scheme? That pension scheme which is referred to in 80CCD, that is nothing but National Pension Scheme account, NPS account. However, there is some upper limit. Employer cannot get full deduction. Employer will get deduction to the tune of 10% of the salary of employee. Instead of 10%, from AY 25-26, the limit is enhanced to 14%. So this is slightly important. 6.36(1) clause 4A, employer's contribution to NPS account. 14% of salary would mean basic for sure, plus dearness allowance also, provided dearness allowance forms part of retirement benefits, or that much dearness allowance which is considered for retirement benefits. So I call it as basic plus DAR. Next is 36(1)(5), employer's contribution. All three, 36(1)(4), 4A, 4A and 5 are all employer's contribution. Employer's contribution to where? Employer's contribution to approved gratuity fund. Approved gratuity fund. So everywhere it should be recognized provident fund, approved superannuation fund, pension scheme, approved gratuity fund account. If it is not approved or not recognized, then as per 40A subsection 9, it will be disallowed. Subject to 43B and subject to 40A7. 43B says that deduction will be allowed only when actually paid, actually deposited by the on or before the due date of filing IT return. Otherwise will be allowed whenever it is actually paid. 40A7 says that deduction will not be allowed only on provisional basis. Deduction will be allowed only when payment is actually made to the employee or payment is deposited in the gratuity fund account with outsider like professional people like LIC. LIC maintains gratuity fund. employer will have to, the money should go out of employer's pocket. Either the amount is actually paid to the employee or it is paid to the fund, what you call gratuity fund, approved gratuity fund, then only deduction will be allowed. Last one, 36(1) clause 5A, this is employee's contribution. Understand the language very carefully. Employee's contribution to any staff welfare scheme. Staff welfare scheme will include provident fund, pension account, gratuity account, etc. Normally, employees don't contribute to gratuity fund account. Employees will contribute to pension account and provident fund account. However, employees cannot contribute directly. Employees can contribute only if routed through employer. So what employee will do? Employee, after receiving salary, employee will hand over some portion to employer. That take this much, my salary is 30,000. Out of 30,000, take back 3,000. 3,000 is my contribution to this provident fund account. In the provident fund account, employer will also contribute. Employer will get deduction under 36(1)(4). That is employer's own contribution. Employee also contributes, but employee cannot contribute directly to this fund. Employee will have to hand it over to employer. Thereafter, employer will deposit in that account. So in the hands of employer, on paper there will be two treatment. If I am the employer, I am first receiving 3,000 from employee, that will be my income. And when I deposit in employee's account, it will be my deduction. I will get deduction. So it will be double entry. The moment I receive from employee, it will be my income. That is step number 1. Step number 2, if I don't deposit within the time limit, I will not get deduction. Deduction I will get only when I actually deposit. So what is the time limit to deposit? Provided it is deposited by employer on or before the due date of depositing under the relevant act. Relevant act does not mean due date of filing IT return. Relevant act means Provident Fund Act, Gratuity Fund Act, etc. Payment of Gratuity Act, and not within the due date of filing IT return. So as far as employer's own contribution is concerned, there is only one time limit for the whole year, which is after the end of the year. For my own contribution, I will get deduction under 36(1)(4). 36(1)(4). I will get deduction if I deposit on or before the due date of my IT return. But as far as employee's contribution is concerned, which is first treated as my income and then I am going to get deduction, there are 12 due dates on a monthly basis. Every month there will be due date. 15th of the next month will be the due date. If I don't deposit by 15th of the next month, then permanently disallowed. So my own contribution I will have to deposit on or before the IT return due date in my own case. But as far as employee's contribution is concerned, for which there are two treatments. First, it is considered as my income. When it comes to claiming deduction, I will have to see to it, I will have to ensure that I deposit it on or before the 15th of the next month, 12 due dates on a monthly basis. Otherwise, it is permanently disallowed. Next is right of allowance for animals or birds. This is unimportant, but I will explain it to you quickly. Other than held as stock in trade. If I am holding animals as stock in trade, that means I am in the business of trading into animals. I buy for 1 lakh rupees, I sell it for 1,20,000. Then purchase price will be allowed to me as a deduction by debiting trading and P&L account. And the sale price 1,20,000 I will be crediting to trading and P&L account. And 20,000 differential amount is my profit. Here we are talking about animals or birds which are held otherwise by way of stock in trade. That means I am holding them for maybe transport purpose. Say my business is in a hilly area where trucks, tempo, etc. cannot go in a hilly area. I use animals. So I purchase camel, donkey, elephant, etc. such kind of animals who can carry weight, who can be used for carriage of goods. In such situation, if I would have purchased a truck or vehicle, then I could have claimed depreciation. But when I purchase animals for transportation purpose, I cannot claim depreciation on the life of animal. So what I can do is that I can claim the difference between the sell price and purchase price whenever animals die or whenever they become useless, and when I sell them off, at that time the difference will be allowed to me as a deduction. For example, I bought an animal, say donkey, for 1 lakh rupee for transportation purpose, for carriage of goods, passengers. 1 lakh rupee is my purchase price. Later on, donkey became useless or he died and I sold the dead body and the body parts. Then if I ended up getting 30,000 rupees from sale of dead body, then my loss is 70,000. 70,000 will be allowed to me altogether in one go under 36(1) clause 6. Next is actual bad debts, and the next to next is 36(1)(7)(a), provision for bad debts. So normally what is allowed is only actual bad debts, provided it is written off from books of accounts. Once upon a time, till long back, till 2010, I think 2009, 2010, there was a condition that one could claim bad debts deduction only when bad debts are proved that the debt has become bad. One had to lodge a police complaint, issue a legal notice. All these provisions are changed. Now only condition is that it should be written off from the books of accounts. Once written off by assessee from his books of accounts, he can claim the debt as having become bad, and he can claim deduction as a bad debt. But what is allowed as a deduction is only actual bad debt. Provision for bad debt or provision for doubtful debts is not allowed except in case of commercial banks and financial institutions under 36(1) clause 7a, where who can claim provision for bad and doubtful debts. Now they also cannot claim actual amount of provision. They can claim provision of bad and doubtful debts only to the tune of certain predefined percentages. What is that? So this table you will have to remember, which is very easy. If the assessee is a foreign bank or a public financial institution, state financial institution, or state industrial investment corporation, mainly scheduled bank, foreign bank, whether scheduled bank or a non-scheduled bank, and the last one is non-banking finance company, NBFC. These three people can claim deduction to the tune of 5% of their total income, irrespective of actual amount of provision created in the books of account. So P&L account debit, provision account credit, irrespective of actual amount, in IT return they will get deduction to the tune of 5% of total income. This deduction is allowed every year without doing anything, meaning thereby, irrespective of the actual amount of provision, whether provision is created or not created, 5% of total income will be allowed as a deduction to these people: foreign bank, PFI, SFI, SIIC and NBFC. As far as scheduled banks are concerned, but scheduled bank other than foreign bank is already covered in point number A. Foreign bank will be getting deduction to the tune of 5% of total income, irrespective of whether foreign bank is a scheduled bank or not. Other scheduled banks other than foreign bank or any non-scheduled bank or a cooperative bank other than two types of cooperative bank which are mentioned in brackets, which is unimportant. Cooperative bank, scheduled bank, they will get double deduction. They will get deduction to the tune of 8.5% of their total income, plus they will get deduction to the tune of 10% of aggregate average advances made by their rural branches. Whatever branches they have in rural area, whatever loans are given, advances are given by rural branches of these banks, 10% of that average advances made by rural branches, aggregate average advance to be computed as per prescribed rule, which you need not study. A plus B, total of 2 will be allowed as a deduction if it is a scheduled bank other than foreign bank. On this, practical question has come only once, long back it came. However, though these deductions are allowed to them, it is not in the form of an extra benefit. Understand very clearly. 36 subsection 2 states that if these banks say P&L account debit and provision account credit, every year 5% of total income, 5% is allowed as a provision of total income, or maybe 8.5%, whatever. Let's say provision created in year 1, P&L account debit, provision account credit, accounting entry will be passed that way. Year 1 provision created 10 lakh, year 2 20 lakh, year 3 30 lakhs, year 1 to 3. Total amount credited to provision account or total provision or total deduction claimed up till now on account of provision is 60 lakh rupees. Now in the current year, year 4, there is an actual bad debt. For this provision, deduction must have already been claimed under 36(1) clause 7a. And now there is an actual bad debt to the tune of 62 lakhs, 62 lakh, for which deduction is admissible under 36(1) clause 7. Provision is under 7a, actual is under 7, only 7. Now, as per 36 subsection 2, deduction will not be 62 lakh. From 62, whatever is already claimed, that much will be deducted. So this 60 lakh government allowed you as a bank, government allowed you as a deduction, but government is not obliging you. This will be reversed. So now in the year 4, the deduction under 36(1)(7) subject to 36(2), how much will be allowed? So 60 lakh, whatever deduction is already claimed, that much will be deducted. Only 2 lakh will be allowed as a deduction. Deduction under 36(1)(7) for actual bad debt will be available to the above mentioned banks or financial institution to the tune of excess of actual bad debt over and above the credit balance of provision account. Credit balance of provision account is 60 lakhs in our case, and the actual bad debt is 62. Deduction will be only to the tune of 2 lakh rupees. The next is section 36 subsection 1 clause 8, transfer to special reserve. Now here this deduction is allowed without doing anything, just that in the books of accounts create one special reserve account. Just pass an accounting entry, P&L account debit, special reserve account credit. That's it. No need to pay money to anybody. Like the way last time we had discussed section 33AB, tea, coffee, rubber development account, or 33ABA, site restoration fund account. Unlike that, here deduction is allowed without doing anything, without actually paying to anybody. Deduction is allowed simply by passing book entry, P&L account debit to special reserve account credit. However, deduction is allowed only to certain people, Indian company or any financial corporation, public company, which is engaged in providing long-term finance. The business should be providing long-term finance for 4 types of development: for industrial development, infrastructural development, agricultural development, or development of housing sector in India. Industrial, agricultural, infrastructural, or housing development, 4 types of development in India. Deduction will be least of the following 3. How much? So, amount actually transferred to this reserve account, or 20% of the profit from such activity. Such activity means activity of providing long-term finance from activity of providing long-term finance for industrial, agricultural or such kind of development. Or third one, which is slightly off the track, understand, it is paid up share capital plus closing balance of such general reserve account. Paid up capital plus closing balance of general reserve, not this reserve, not special reserve, general reserve account, but closing balance. Closing balance means as on 31st March. As on 31st March plus paid up capital, take the total of these two into 2, that is 200%. First you take total of these two, paid up share capital plus general reserve account, but general reserve account balance as on 31st March. Take the total multiplied by 2, that is 200%, and from that subtract. Now there is a closing bracket here. So first you do this double of these two and then subtract opening balance of this special reserve account. Opening balance as in balance as on 1st April. General reserve account balance, closing balance, and special reserve account balance, opening balance. General reserve account balance to be added to the paid up share capital and to be doubled up, and this special reserve account balance to be subtracted, but as on 1st April. Whichever is least will be allowed as a deduction. Without doing anything, money is not to be handed over to anybody. What will happen if there is a withdrawal, means special reserve account debit, P&L account credit, then withdrawal will be taxable in the year of withdrawal, 41(4)(a), which is deemed profit, which we will be discussing later on. Now next is very important, 36(1) clause 9, expenditure on promoting family planning amongst employees. This deduction is allowed only to companies, no other person. If it is revenue expenditure, then it is allowed in one go in the same year in which expenditure is incurred, and full amount is allowed. But if it is a capital expenditure, then it is allowed as a deduction in 5 installment, 20% per annum into 5 years. 5 years starting from which years? 5 years starting from the year of incurring such expenditure. It is important and it is very small. Remember, not allowed to anybody other than company. This is an important point, that it is allowed only to companies. Then 36(1), 14 and 15. 14, contribution to approved credit guarantee trust fund, which is totally unimportant, so you can cancel it off. Next is important, STT, securities transaction tax, provided the income from buying and selling of securities is taxable under the PGBP. If it is taxable under the capital gain, then in capital gain chapter it is not allowed as a deduction. Here it is allowed as a deduction. Okay, so I'll give you one example for this. Say in case I buy security for 100 rupee and at the time of purchase I paid STT 1 rupee. So my total purchase price is 100 plus 1, 101. And later I sold it for 300 rupees, and while selling I paid 3 rupee STT, which will be subtracted from my sale consideration. I will receive 3 rupees less. I will receive 297. So total STT paid by me is 4 rupee. Now question is, how much is my taxable profit? Taxable profit is 300 minus 100, 200, or it is net of STT, that is 297 minus 101, 196. So answer, if it is taxable under the PGBP, then 196 will be taxable. STT will be allowed as a deduction, total STT. If it is taxable under the capital gain, then 200 rupee will be taxable, because in capital gain chapter STT is not allowed as a deduction. Right? In case you want to take a screenshot of this example, you can pause the video and do the needful. Okay, next is CTT. Section 36 subsection 1 clause 16, commodities transaction tax. This is again allowed as a deduction provided income from buying and selling of derivatives of commodities is taxable under the PGBP. Income therefrom is taxable under the PGBP. Now here we are not talking about actual commodity, tea, coffee, rubber, copper, oil, etc. We are not talking about actual commodity, we are talking about derivatives of commodity, because CTT is charged only on derivatives, not on actual commodity. Provided income is taxable under the PGBP. If income is taxable under IFOS, then not allowed. CTT questions have never come, so it is unimportant. 36(1)(17), which is totally unimportant. Deduction allowed to sugar manufacturing cooperative society on account of payment for purchase of sugar cane at a price fixed by government or less than that. No one has been able to understand what is this. Had this not been there, then also purchase price paid for purchase of sugar would have been allowed as a deduction otherwise also. Last one is mark to market loss, M2M loss, as per ICDS. This is unimportant, but just keep it in your mind. It is allowed only with regards to shares and securities, provided they are held as stock in trade, then only income will be taxable under the PGBP. Otherwise, it will go under the capital gain. In case you are holding shares or securities as stock in trade, whereby income is taxable under the PGBP, you purchase for 100 rupee. Now on 31st March, the FMV on 31st March of the financial year is 107. Then there is a 7 rupee of notional profit, nothing to be done. But you purchase for 100 rupee, now the FMV is 93 rupees, then there is a 7 rupee of notional loss. This is called mark to market loss. This 7 lakh or 7 rupee is not suffered as a loss, actually it's a notional loss, then also deduction will be allowable for that. There are 20 such expenditures which is done. Okay, first 3 we merged together, that's why it was number 1, and plus totaling goes on till 18. So 2 of them were merged with the first one, that's why, that's how total is 20. Yeah? Don't look at the serial number, total is 20, you can count it. Then generally allowable expenditure. Government says we can't mention each and every expenditure in writing under the Act. So any other expenditure which is not covered by previous 37 expenditure governed by section 30 to 35E plus not covered by section 36(1) 20 expenditure. Any expenditure which is not covered by these expenditure will also be allowed as a deduction under this head, provided 5 conditions are cumulatively satisfied. All 5 to be satisfied. 3 negative conditions, 2 positive conditions. Which are they? We will discuss them. Any expenditure not covered by section 30 to 36(1). That's technically a primary condition plus 5 more condition. 5 condition. But primary condition is the given expenditure should not have been covered by section 30 till section 36(1). Plus it fulfills 5 conditions. First 3 negative, last 2 positive. It should not be a capital expenditure. It should not be a personal expenditure. If it is capital expenditure, then you can claim depreciation, but you can't claim the deduction of the cost of acquisition unless it is specifically allowed, like 35 AD, section 35 scientific R&D. It should not be personal. It should not have been incurred for any purpose which is an offence under any law or any purpose which is prohibited under any law. Then there is a clarification later in explanation 1 and explanation 3 to section 37(1). There are some extra points clarified. But it should not be capital, it should not be personal, it should not be an offence under any law, or it should not have been prohibited under any law. And which are the 2 positive conditions? It should have been incurred during the previous year and it should have been incurred wholly and exclusively in connection with business or profession of the assessee. If it is incurred last year, not in the current year, claim deduction last year. Incurred for the next year, paid right now, then claim deduction next year whenever expenditure falls due. And the last is, it should have been incurred wholly and exclusively in connection with business profession. If it is partly also for personal purpose, then it will be disallowed. 3 explanation. Number 1, penalty. First one clarifies about penalty. Penalty under any law for breach of law. Penalty. Penalty can be called by different name also, can be called as compounding fees, regularization fees, or by whatever name called, for breach of any law, for infraction of any law, will not be allowed as a deduction. Why? Reason, it will not be considered as wholly and exclusively in connection with business profession. Not incurred for business profession, that is the reason, that's why it will not be allowed. Now this particular point is relevant for minimum alternate tax chapter also, AMT chapter also, and couple of other chapters also, like partnership firm. But here we are discussing it, so understand it. You have already studied it at inter CA level, final CA it is getting repeated. Not allowed. Penalty for, however, breach of contract. If it is not for breach of law, if it is for breach of contract, then it will be allowed, provided it is revenue in nature. So for contract, there can be 2 types. Contract penalty for breach of contract can be revenue in nature, allowed. If it is capital in nature, then not allowed, because it is capital expenditure, then it will be disallowed under this point. Okay, second explanation is very important. CSR expenditure not allowed. Corporate social responsibility expenditure. And third one explanation recently introduced, and There were 3 points, one more point introduced by AY 2526 which we will be discussing. It says that the given expenditure should not amount to an offence under any law, or it should not be for a purpose which is prohibited under any law. So expenditure incurred for purpose which is offence under any law or prohibited under any law is not allowed. Then what exactly will it include? So answer, it will include following things also. Number one, which is a major clarification, that when we say it is prohibited under any law, then it does not mean law under any act in India. It could mean under any law outside India also. So that is a clarification. So in case of one person, he was carrying some goods which were confiscated in Saudi Arabia, because in India it was not prohibited, but in Saudi Arabia it was prohibited, some poppy seeds or something. So in such situation, it will be expenditure incurred for that will be disallowed. Though it is not prohibited in India, but if it is prohibited under any law outside India, then also it is prohibited in case you ended up paying penalty for breach of that law in India or breach of law outside India. Just having a law outside India is not enough. You have breached that law. When would you be breaching that law? You would be breaching that law when you are carrying such substances or carrying such prohibited items outside India, in that country. Second, in case the expenditure, what are we discussing? We are discussing explanation 3 to section 37(1), which talks about clarification of what expenses can be considered as incurred for a purpose which is prohibited under any law. So expenditure is incurred in providing any benefit or perquisite to any person, ideally to doctors, for carrying business profession. That person is carrying business if acceptance of such benefit or perquisite by such person is in violation of any law. So what had happened was, many pathological laboratories and pharmaceutical companies, they end up paying or they end up providing benefits to doctors and requiring doctors to prescribe unnecessary pathological tests and unnecessary medicines, expensive medicines, whereby doctors get commission. Not all doctors are like that, but 10%. Now what happens is, in each and every profession there is something like that. 10% of chartered accountants, 10% of engineers are like that. Every profession has 10% such kind of rotten people. Okay, so in case if the doctor has accepted, then Indian Medical Association IMA had issued one circular or made some regulation whereby doctors are no more allowed to accept such benefit or perquisite, foreign trip or any benefit or any commission or any kind of money. Doctors are prohibited. So one pathological laboratory, their matter went up to Punjab and Haryana High Court. They said doctors cannot accept it. We are allowed to pay. There is no prohibition on us. Why are we being disallowed? So pathological laboratory, which was a company, paid commission to the doctor to prescribe to its patients unnecessary tests, and doctors prescribed. Accordingly, pathological laboratory paid commission running into crores of rupees. Claimed it as deduction by pathological laboratory. AO disallowed it. Matter went up to Punjab and Haryana High Court. Pathological laboratory assessee asked one question, that sir, which law have we prohibited, or which law is prohibiting us from making payment? Which law have we violated? So Punjab and Haryana High Court dismissed the case, saying that you have breached the law of principles of natural justice, or you have natural law is breached. Some such kind of explanation was given by Punjab and Haryana High Court. Assessee did not go up to Supreme Court, but any which ways, so government clarified, even if it is in violation of not only law, but if it is in violation of any rule or regulation or any guideline which governs the conduct of such doctor or such person. So there was a guideline issued by Indian Medical Association. So that's pathological laboratory in our case argued that sir, this is guideline by Indian Medical Association. It is not a law. It is not a law. Even if that guideline is breached, it cannot be considered at par with violation of any law. Therefore, it should not be disallowed. Next one, for compounding any offence. So earlier there was a case law of Karnataka High Court where assessee claimed deduction of some amount paid to the municipality for illegal construction, but they call it as compounding fees. Okay, so at that time Karnataka High Court clarified that even if you change the name, instead of penalty you call it as compounding fees, the characteristics will not undergo changes. It is still penalty only, therefore disallowed. This is officially incorporated under the law that even if it is called by the name of compounding of an offence under any law in India or outside India, then that expenditure will also be considered at par with penalty and accordingly will be disallowed. Even though the word penalty is not used anywhere, even though we are calling it as regularization fees or compounding fees, it is still at par with penalty. And last one, clarification inserted by AY 2526 on 23rd July 2024, date is unimportant, saying that any expenditure incurred to settle any proceedings initiated in relation to such law as may be notified by central government. So even if any money is paid or expenditure is incurred to settle the proceeding, liasoning charges or settlement, that you pay 50 lakh rupees and we will let you go. Officially, to say Saudi Arabian government, you paid 5 crore rupees and they let you go. Officially, it is allowed. Saudi Arabian government allows it. Many other governments allow it. Pakistan also allows it, that you pay huge amount, 2 crore, 5 crore rupees, and we will let you go, which is called settlement case or settling the proceeding, amount incurred or amount paid for settling the case. That will also not be allowed. That will be considered as a violation of any law in India or outside India. Just a note that what kind of expenditures will fall under 37(1). So all day-to-day expenditure, majority of day-to-day expenditures fall under 37(1) because they are not covered by section 30 to 36(1), like salary to staff, electricity bill, telephone bill, indirect taxes, GST, customs, etc. STT is covered and CTT are covered, and income tax is not allowed, wealth tax is not allowed, STT, CTT allowed. But what about GST? There is no clarification, there is no section. So even stipend to articles, telephone, mobile, electricity, indirect taxes will all be allowed under 37(1). Disallowable expenditure, now shifting to the second part of the chapter, disallowable expenditure. So before we start with the disallowable expenditure, there are two clarifications. If you recollect, we had discussed one chapter, chapter 12, special rates of tax, and thereafter immediately chapter 12A, that was NRI taxation. In these two chapters, we had discussed that for both the chapters, wherever assessee is non-resident, the given income is taxable at or taxable on a gross amount basis without claiming deduction of any expenditure incurred to earn the income, or without claiming chapter 6A, or without claiming any basic exemption. So incomes covered by these section 115A, 115AB, AC, AD, BBA, BBF, BBG, D. D is a part of NRI taxation. Incomes covered by special rates of tax chapter and incomes covered by NRI taxation, which whatever can fall under this chapter, PGBP. Whatever can fall under IFOS, like winning from lottery, 115BB, that we are not talking about here, because here this chapter is PGBP chapter. So we will not talk about those incomes or expenditure on those incomes which are taxable under some other head. And secondly, those companies, domestic companies which have opted for 115BAA 22% tax rate or 115BAB 15% tax rate, or individual HUF, AOP, BOI, AJP whose incomes are computed under 115BAC subsection 1A, that is new tax regime NTR, or a resident cooperative society which has opted for 115BAD or BAE 22% or 15% tax rate, they cannot claim deduction under section 32 subsection 1 clause 2A, additional depreciation on plant machinery. They cannot claim 33AB tea, coffee, rubber development account, or 33ABA site restoration fund account development, or 35(1) clause 2, clause 2A, clause 3, 2AA, 2AB, 35AD, 35CCC, 35CCD. These scientific R&D expenditure cannot be claimed. Recently, question came on the scientific R&D expenditure. In 35AD is 14 specified businesses: cross-country pipeline network, agricultural warehouse, sugar warehouse, hotel of 2-star and above, hospital of 100 patient beds and more. 35CCC is agricultural extension project, and 35CCD, which is allowed only to companies, skill development project, SDP. These expenditure, and we have already finished discussing all these in the previous video, part 1 of this chapter, where we discussed that in respective sections also we discussed that deduction, given deduction not allowed to those who have opted for these special schemes. Otherwise, disallowable expenditures, while revising, I would revise in the form of table. Wherever any explanation is required, any extra point is required, I would have covered it down the line here, all these pages. But otherwise, disallowable expenditures, they run between section 37(2)B till section 43B. From here till here, so many sections are there. One by one we will be discussing, starting with 37(2)B, which used to be an important section for inter CA. Now at final CA stage also slightly important, not very important. Expenditure on advertisement. Advertisement where? But advertisement in a newspaper, magazine, journal, etc., which is published by a political party. Published by a political party, like Times of India. If you give advertisement for your business in Times of India newspaper, then it is allowed, subject to TDS. But in case if the same advertisement is given in a political party's newspaper, like in Maharashtra there is one newspaper called Samna, which is run by political party Shiv Sena, then expenditure will be disallowed. However, that advertisement in a newspaper, magazine, etc. run by a political party, though it is disallowed as an expenditure under the PGBP, it will be considered at par with donation or a contribution to a political party, and making the assessee eligible to claim deduction under section 80 GGB, but this facility is only for Indian company, not for others. So, if the assessee is an Indian company and there is an expenditure by way of advertisement in a newspaper, etc. of a political party, then double effect. As a business expenditure, add back. First you add back, then you subtract it under section 80 GGB. Separately after calculating GTI. First add back while computing PGBP income, and then after taking total of all the heads of income from the gross total income GTI, claim deduction on account of contributing to political party separately. 100% deduction is allowed of whatever amount is paid. If it is other than company, for company it will be like this, other than company only one treatment, add back, that's it, under 37 subsection 2B. No 80 GGC or 80 GGB in case of other than company. If assessee is a partnership firm, then only one treatment, add back, that's it. Section 38, which is very ordinary section, without studying also you will be able to apply this provision. In recently we discussed 37(1) where we said 5 conditions. One of the condition was it should not be a personal expenditure, and the last condition was positive condition, it should have been incurred wholly and exclusively in connection with business profession, wholly and exclusively. So even if it is partly for personal purpose, if it is entirely for personal purpose, then it is disallowed. If it is partly for personal purpose, then also that expenditure should entirely be disallowed. But section 38 says that 3 expenditure which are partly for personal purpose, partly for professional purpose or business purpose, then part of the expenditure will be disallowed. Whatever part pertains to personal purpose will be disallowed, and whatever part pertains to business purpose will be allowed. 3 expenditure: rent, repair and depreciation, RRD, rent, repair, depreciation. Rent, repair, depreciation for what? For building, plant machinery, furniture fitting. 3 assets, 3 expenditure: building, plant machinery, furniture fitting, rent, repair, depreciation, partly for business profession and partly for personal purpose. Then that much part which pertains to personal purpose will be disallowed, and whatever pertains for business purpose will be allowed. Section 40 clause A is the most important one, as various sub clauses. Generally for TDS, section 40 clause A subclause 1, it says payment to any non-resident without complying with TDS provision, then 100% will be disallowed. However, 2 types of default, either of the 2 defaults will lead to this disallowance. Number 1, either tax is not deducted, if deductible and not deducted by the end of financial year, by 31st March if it is not deducted, or number 2, or second default, deducted by 31st March but not deposited on or before the due date of filing IT return, then 100% will be disallowed in that year. This is the temporary disallowance. Right now it is disallowed. Later on, whenever the TDS is deposited, at that time it will be allowed as a deduction, probably next year. Same way, instead of non-resident, if the payment is to a resident, then 40 clause A subclause 1A, payment to resident person without complying with TDS provision, that is either tax is not deducted by 31st March or deducted but not deposited on or before due date of filing IT return, then 30% will be disallowed as compared to 100% in case of non-resident. 40 clause A subclause 1B equalization levy. We have a separate chapter on equalization levy for which video is already recorded and uploaded also. You can have a look at it. In case you have yet to watch it, please go and watch that video. 40 clause A subclause 2 and subclause 2A, income tax and wealth tax not allowed. Then there is a clarification with regards to income tax. Income tax is defined in section 2 clause 43. Income tax is defined which includes only income tax. There is no clarification with regards to surcharge and health and education cess. So explanation 2 was inserted, which I have covered here separately. Explanation 3 was inserted saying that tax will include and shall be deemed to have always included surcharge and cess on income tax by whatever name called as, meaning thereby when we say tax here for the purpose of 40 clause A subclause 2, income tax will include surcharge and health and education cess also. This will have the effect of negativing the Bombay High Court decision. There was a Bombay High Court decision in case of public listed company called Sesa Goa Limited, where Bombay High Court delivered a classy decision stating that according to section 2 clause 43, income tax includes only tax. Tax includes only income tax, does not include surcharge and health and education cess. Therefore, what is disallowable under 40 clauses subclause 2 is only income tax but not surcharge and health and education cess. Deduction should be allowed. Of course, under section 37(1) generally allowable deduction, deduction should be allowed for surcharge and health and education cess, which decision of Bombay High Court gets negatived by amendment retrospectively carried out by Nirmala Sitaramanji. Wealth tax is no more there, so I am deleting that. 40 clauses subclause 2b unimportant totally. Payment by state government undertaking to state government. State government undertaking is an assessee liable to tax, but the state government itself is not an assessee, not liable to tax. So, to avoid tax or to evade tax, what most of the state government undertakings do is that they transfer some of their profit to state government by the name of royalty, service fees, privilege fees, etc. Chidambaramji introduced this clause saying that it will no more be allowed as a deduction if payment is made by state government undertaking to the state government. Okay, it is like transfer pricing kind of a thing. Taxable entity makes payment to non-taxable entity. Payment can be made, but if it is for some proper charges, if it is paid in the name of royalty, huge profit is transferred, then that will not be allowed. 40 clauses subclause 3, which is again in connection with TDS. So, for TDS we have 3 subclauses, 40 clauses subclause 1, subclause 2, subclause 1a and subclause 3. Okay, what is subclause 3? Subclause 3 is payment of salary to non-resident. Salary to non-resident is paid without deducting tax as well as without depositing TDS, then 100% of such salary will be disallowed. However, this is the permanent disallowance. For earlier 2 points, 40 clauses subclause 1 and subclause 1a, payment to non-resident 100%, payment to resident 30% if there were any one of the 2 defaults. Number 1, either tax is not deducted by the end of the current year or tax is deducted but not deposited on or before the due date of filing IT return. Whereas for 40 clauses subclause 3 it says tax is neither deducted nor deposited. Both the defaults have taken place, 1 plus 2, then only it will be disallowed. Secondly, first 2 were temporary disallowances, right now disallowed, later on when the provisions are complied with, in that year it will be allowed as a deduction. But so is not the story with regards to 40 clauses subclause 3, here it is a permanent disallowance, once disallowed, lifetime it will be disallowed, it can never be reversed. 40 clauses subclause 5, which I will be describing in detail when we come to TDS chapter. Here, tax on non-monetary perquisite, employer-employee, tax on non-monetary perquisite offered by employer to employee. Employer offers to employee non-monetary benefit, non-cash benefits like residential accommodation is provided or motor car is provided. On these non-monetary perquisite, who will bear the tax? Tax is ideally to be borne by employee because value of these perquisites will be added to his salary. Tax is supposed to be covered up in the form of TDS, means tax is supposed to be borne by employee. Instead of employee, if it is paid by or borne by employer or paid by employer, then the amount paid by employer should once again be added to the employee's salary as an extra benefit. Obligation of employee met by employer or discharged by employer, it should be added as a perquisite. But employer will not get deduction, employer should be getting deduction and employee should be taxed for that. I am the employer, you are employee, I paid on your behalf, which is your obligation, but I am paying, I should get deduction, you should be taxed. But neither you will be taxed, you will be exempt under 10(10)(c) and I will not get deduction as per 40 clauses subclause 5. This is unimportant, it never comes in the exam at CA final specially. 40 clause B, payment made by partnership firm to the partner, including LLP making payment to partner of salary, commission, bonus, remuneration or interest. Interest on capital, interest on loan, salary, bonus, commission or any other remuneration by whatever name called as, or interest. Interest, 2 types of interest, interest on loan given by partner to the firm or interest on capital contributed by partner to the firm, will be partly disallowed and partly be allowed. How much is allowed, how much is disallowed? We have a separate chapter on this 40 clause B in the name of assessment of partnership firms and LLP, which I have covered it in detail. Here the limits are totally changed. As far as interest is concerned, we know pretty well, interest 12% per annum, simple interest is allowed, maximum. And as far as salary, commission, bonus, remuneration are concerned, up to 3 lakh rupees of book profit, 90% was allowed, and above 3 lakh book profit, 60% is allowed. The limits have been changed from AY 25-26. Instead of 3 lakh, it shall be replaced by 6 lakhs. So now the new limits is up to for 6 lakhs of book profit, 90% of such book profit will be allowed, and beyond 6 lakhs, 60% of book profit exceeding 6 lakhs will be allowed. But as far as partnership firm and LLP are concerned, we have 40 clause B. Something will be allowed, something will be disallowed. But as far as AOP, BOI are concerned, making payment, AOP, BOI paying to their members, then nothing will be allowed on account of salary, commission, bonus, remuneration or interest. Nothing will be allowed as a deduction to the AOP, BOI. And both the places, how much will be taxable in the hands of partner or member? Only that much will be taxable in the hands of partner or member, for which deduction is allowed to the firm, LLP or AOP, BOI. 40A, big A, capital A. Here there are 1, 2, 3, 4, 5, 6 subsections which we will be discussing. 40A2 is important even at final CS stage also. Excessive payment. Excessive payment, that is more than market value. Excessive would mean more than market value. Excessive payment to a relative or a substantial interest holder will be disallowed. How much will be disallowed? Only excess amount will be disallowed and not the entire amount. However, provided it is paid to relative or a substantial interest holder. However, 40A3 is also equally important, which says that cash payment exceeding 10,000 in one single day to one single person. It doesn't use the word cash payment, it says payment made by assessee for business profession to any person exceeding 10,000 in one single day to one single person, otherwise by way of account pay check, account pay draft, ECS or prescribed electronic modes, then 100% entire amount will be disallowed and not only the amount exceeding 10,000. Instead of 10,000, limit will be 35,000 in a day, per day limit will be 35,000 while making payment to a transporter. In case if the payment is made in the current year and deduction is also in the current year, then 40A3. But if deduction was already claimed in an earlier year on accrual basis without making payment, say last year deduction was claimed on due basis, accrual basis, and now in the current year if the payment is made, then in such situation 40A3A will be applicable, whereby don't go backwards to last year, don't go backwards and disallow in that year. Consider that payment as income, as deemed income. Payment in the current year in cash exceeding 10,000 or exceeding 35,000, entire amount will be deemed as income in the current year. So don't go backwards and disallow in the last year, give effect in the current year of making payment. 40A7, provision for gratuity. It says for gratuity, if it is provision, then not allowed on provisional basis. Deduction is allowed only when actually paid. Now, gratuity is not allowed as a deduction under 40A7. 40A subsection 7 imposes a restriction. Gratuity is allowed as a deduction under section 36(1) clause 5. 36(1)(5). Here we had discussed, I will show you. 36(1)(5). Here. 7 point. Employer's contribution to employees approved gratuity account. Subject to 43B and subject to 40A7. Here we had discussed 40A7. So now what is 40A7? So 40A7 is not an allowable expenditure category. It is imposing restriction. Deduction will be allowed under 36(1)(5) if allowable. 40A7 imposes a restriction that deduction will be not allowed in case if it is only provision. However, subject to exception, it says provision will be allowed provided whatever amount of provision is claimed or created, same amount is going out of pocket of assessee, meaning thereby assessee has actually contributed to an approved gratuity fund like LIC, then only deduction allowed. 40A9, if you recollect, deduction on account of employer's contribution to approved superannuation fund or recognized provident fund allowed as a deduction under 36(1)(4) or this approved gratuity fund 36(1)(5). All these places deduction is allowed under subclause 4 and 5 only if the payment is made to an approved fund or a statutory fund or a recognized provident fund, etc. If the payment is made to any unrecognized fund or unapproved fund or a non-statutory fund, then it will be disallowed under this particular employer's contribution. 40A13, which is useless, it says except of mark-to-market loss given in 36(1)(18), except of mark-to-market loss, no other loss will be allowed. Except of mark-to-market loss, no other loss shall be allowed. That is okay, we don't even claim also. And the last one is 43B. 43B is the last disallowance section category. 43B applies to 9 expenditures, and you know pretty well it is allowed. It says these 9 expenditures will be allowed to be deducted only if either the payment is made by the end of the previous year, between 1st April 24 to 31st March 25, or payment is made in the next year, but next year it should be made on or before the due date of filing IT return. Otherwise, right now it will be disallowed if payment is not made. However, it's a temporary disallowance which says that deduction will however be allowed in that year in which the payment is actually made. It applies to 9 expenditure. Which 9 expenditure? First one is tax, duty, cess, fees, which is important one from exam perspective. But which tax? Income tax and wealth tax are not allowed. We are talking about not income tax, wealth tax. We are talking about indirect tax, which is allowed otherwise under section 37(1), or any kind of statutory fees payable, license fees. If I am running a restaurant, beer bar, dance bar, then I have to pay some license fees to state government. Then that particular fees I am talking about, that will be disallowed if the payment is not made. Next 3 points are with regards to employer-employee. Employer paying to employee. Number 1, employer paying bonus commission to employee. Bonus commission is allowed under section 36(1) clause 2. 43B imposes a restriction. Deduction will be allowed under 36(1) too. But this section imposes a restriction. Deduction will be allowed subject to condition of payment. Leave salary encashment to employee. Leave salary encashment will be allowed under 37(1) because there is no specific section, subject to condition that payment should have been made in the current year. Employer's contribution to recognized provident fund or approved superannuation fund. Recognized provident fund and approved superannuation fund is allowed as a deduction under 36(1) clause 4. And approved gratuity fund, contribution of employer to approved gratuity fund, deduction is allowed under 36(1)(5), which we just discussed here only while discussing 40A9. So 43B says that deduction will be allowed with regards to employer's contribution only when it is deposited in the given fund on or before the due date of filing IT return. For employer's own contribution, it should be deposited on or before the due date of filing IT return. But as far as employee's contribution is concerned, it should be deposited on or before the due date applicable to the given fund, which is 15th of the next month, 12 due dates on a monthly basis. Then 3 types of interest, 3 types of payment by employer to employee or contributed by employer in the employee's account. Next 3 are interest. Interest on loan taken from scheduled bank, interest or cooperative bank, interest on loan taken or money borrowed from public financial institution, state financial institution or state industrial investment corporation, which is unimportant. Important is 5th one, interest on money borrowed from scheduled bank or a cooperative bank, or interest on loan taken from notified NBFC, which was introduced few years back only. These 3 interests will be allowed. If I take loan from you and I don't pay you interest on time, or if I don't pay you interest up to the due date of filing IT return, then also I can claim deduction. But if I have taken loan from a scheduled bank or notified NBFC, if I don't pay the interest, I will not get deduction till the time I actually make payment. So 3 points, employer to employee, 3 points interest. First one is the most important, tax, duty, cess, fees. Next one is unimportant, payment to railway or amount payable to railway for use of railways assets. Question has never come on this and will not even come also, it is unimportant. Last one, very important, recently introduced AY 24-25 and had become talk of the town. Payment or amount payable to micro or a small enterprise covered under Micro, Small and Medium Enterprises Development Act, MSMED Act, Micro, Small, Medium Enterprises Development Act 2006. Meaning thereby, but before we proceed further, let me warn you, this particular 9 point is applicable only while making payment to or when the amount is payable to micro or small enterprise and not to medium enterprise. Section does not apply to payment due to medium enterprises, though the act is applicable to, this MSMED Act is applicable to all the 3, micro, small, medium enterprise. This point is applicable only while paying to micro or small enterprises. If the payment is not made to these people within the time limit given in section 15 of the MSMED Act, which is 15 days, maximum 15 days, in cases if the time limit for making payment was described in the invoice, or if no time limit is mentioned in the invoice, then time limit will be 45 days from the date of delivery of goods or receipt of services, as the case may be. Here, the payment is not made within 45 days, then deduction will be disallowed in the current year. Deduction will then be, again temporary disallowance, deduction will then be allowed later on in that year in which the payment is actually made. So for earlier 8 points, the time limit is payment should be made either by the end of the previous year or on or before the due date of filing IT return, whichever is later. But for 9th point, it says payment to MSME, or that is micro or small enterprises, payment should be made to them either within the end of the previous year or within 45 days from the date of receipt of goods or service, as the case may be, whichever is later, end of the previous year or 45 days, whichever is later. Here time limit is not extended till the due date of filing IT return. Either make payment within 45 days or make payment by the end of the financial year by 31st March. Otherwise, deduction will be allowed in that year in which payment is actually made. So if I make payment to any micro or small enterprise after 45 days as well as after the end of the previous year, if I make payment, for example, on 2nd April 2025, then I will get deduction in 25-26 financial year. But for first 8 payments, I will get deduction in 24-25 financial year, even though I am making payment in 25-26. Okay. Now, so point number 1 in connection with 43B, point 1, 43B is a temporary disallowance. It says above expenditure except in case of point number 9. Point number 9 means payment to micro or small enterprises. That is sums payable to micro or small enterprise. Barring 9 point, for all other 8 points, if the payment is not made up to the due date of filing IT return given in section 139(1), IT return, but due date of IT return of which year? Due date of IT return of that year in which the liability to pay is incurred. And not next year's due date, next to next year's due date of filing IT return. No, only IT return due date of the first year, the year in which liability is incurred. Only in that year you have time limit to make payment, you have extended time limit, either pay by 31st March or up to the due date of filing IT return. That extra time limit up to the due date of filing IT return is available only for the first year. Next time onwards, now if you make payment, then whenever you make payment in that year, deduction is allowed. Then it will be allowed as a deduction the same year in which actual payment is made, in the year in which actual payment is made, if not paid up to the due date of filing IT return. Second point is important. Questions have already come, practical questions. Sometimes what happens is banks convert outstanding loan into a fresh loan. Outstanding loan or outstanding interest is converted by bank or NBFC into fresh loan or borrowing, or sometimes it is converted into debentures or any similar instrument like bonds, whereby liability to pay is deferred or postponed to a future date. Will it be considered as a payment? So in the books of accounts of bank, I have 10 lakh rupees of loan and 1 lakh rupee interest payable. 10 lakh loan, 1 lakh interest. Total 11 lakh payable. What bank did? Bank granted me one more loan for 1 lakh rupee, and from the second loan, it discharged the interest of the first loan. Then in such situation, in banking language, it may be considered as a payment, but here it is deemed payment and not the actual payment for the purpose of 43B. Therefore, interest 1 lakh rupee which is converted into second loan, then also it will not be considered the actual payment. Accordingly, I will not get deduction in the current year, but I will get deduction of this 1 lakh whenever I actually pay, will be allowed whenever actually paid. Even though when I actually pay next year, at that time it is in the form of second loan, principal amount of loan as a loan number 2, but not in the form of interest, then also from Income Tax Act perspective, payment made by me will be considered as not principal amount of loan number 2, it will be considered as payment towards interest of loan number 1 and will be allowed as a deduction. This is specifically given in the Act. As per section 23 of MSME Act, which was amended with effect from 1st July 2020, that is during Corona lockdown, government amended the definition and expanded the scope. More number of people are now covered under MSME, but unfortunately our institute in module, they have not updated. Okay, it is to be read in conjunction with some government circular, whereby micro and small definition, whether the enterprise is micro or small or not, will have a meaning based on two factors: investment in plant machinery and equipment, and number 2, annual turnover. In order to be called as micro enterprise, it should have investment in plant machinery up to 1 crore only, and plus, it is plus, be careful, it's not 1 or 2, it is 1 and 2, and the annual turnover should be up to 10 crore rupees. And in order to be called as small enterprise, it should have a turnover up to 50 crore and investment in plant machinery equipment up to 5 crore rupees, both the condition to be fulfilled. So 1 crore and 10 crore, 10 times, 5 crore and 50 crore, 10 times of 5 crore. is easy to remember. However, I don't think so our institute will expect you to have knowledge of this particular table, which is not a part of Income Tax Act, which is a part of MSME Act. But institute will clarify in the question that this is micro enterprise, this is small enterprise. Up till now question has not yet come, question is expected anytime. Now then there is rule 6DD. 6DD with regards to 40A3, cash payment exceeding 10,000, 35,000 in one single day to one single person. These are 11 exceptions. Concept of 40A3 will not apply in case of following 11 cases. These are 11 exceptions. Some of them are important from exam perspective, so I'll go little faster and we'll finish off only important points. Number one is important: payment made through any banking channel or payment made to bank or credit institution where the beneficiary itself is a bank. So there's a clarification that I deposit in your bank account. If I was to pay you 80,000 rupees for my expenditure, I was to pay you 80,000 rupees. If I don't pay you in cash, but I go and deposit in your bank account, I take down your bank account details, I go to your bank and deposit 80,000 in your bank account, it will not be considered as payment to bank. It will be considered as payment by me to you by depositing it in your bank account, but it is not considered as a payment to bank, though I am actually going to the bank and depositing it. So it should be a case where the beneficiary is bank, then only it will be called as a payment to bank. Payment made to central government, state government, payment made by way of any other banking channel like letter of credit, telegraphic transfer, bills of exchange, etc. payable to bank. And fourth one is also important: payment by way of book entry or journal entry, whereby I had to pay you 10 lakh rupees for some expenditure and you were to pay me 11 lakh rupees. So you ended up paying me, rather than me paying you 10 lakh, you paying me 11 lakh separately. We decided to square it off by passing journal entry and you paid me 1 lakh by account payee check. So technically you have made payment of 11 lakh to me. Out of 11 lakh, 1 lakh you have paid me by account payee check. First 10 lakh rupees you paid me by way of accounting entry and I also paid you 10 lakh rupees by accounting entry. Then it is fine. It is not violative of 40A3. Fifth point is very important. Most of the questions in exam in the past were based on fifth point. The payment is made for purchase of any agricultural product, forest product, product of animal husbandry like livestock, meat, skins, dairy products, poultry farming products, fish or fish products, products of horticulture, that is gardening, flowers, or products of apiculture, that is beekeeping, honey, beeswax. Whether these products have been subjected to further processing or not, if you are buying any of these products for which you are making payment, provided you can make cash payment exceeding 10,000 without attracting disallowance, provided payment is made to cultivator, grower or producer of such product and not to any middleman or not to any shopkeeper. In exam, one of the questions I remember, institute asked one question that somebody X Limited is running a restaurant. And for the restaurant business, they made cash payment and purchased fruits, vegetables and fish. They purchased. They made payment to the cultivator or the farmer. Farmer they paid 50,000 in cash and 30,000 they paid to shopkeeper to purchase vegetable in one single day in cash. Then 30,000 paid to shopkeeper will be disallowed fully, whereas 50,000 rupees paid to the farmer will not be disallowed under this particular clause. It is exception. Okay, then payment made to producer of products which are manufactured or processed without the aid of power. That means handmade items in a cottage industry. Provided payment is made to the producer and payment is made for purchase of these products and not for other things. Then payment made to a person who ordinarily resides in a village or he ordinarily carries on his business in a village where banking facility is not available. This is unimportant in today's scenario. Fifth and sixth are important. Sixth is also important. Seventh is unimportant. Eighth is also unimportant. Terminal benefits, that is retirement benefits paid to employee up to 50,000. Payment should not exceed 50,000 in aggregate. Can exceed 10,000 rupees in cash but should not exceed 50,000 in totality. Provided payment is made after deducting TDS if at all, whether payment is made to employee or to his legal heirs. 9 point, 8th is unimportant, 9th is also okay, 9th is not that important. Payment of salary to an employee, provided employee was posted temporarily for a period of more than 15 days. Temporarily posted, not permanently posted, temporarily posted for a continuous period of 15 days or more at a place which is other than his normal place of duty, or he is placed on a ship, then if salary is paid to him in cash exceeding 10,000, then it's fine, no problem. Or salary is paid to him in cash on that place, at that place, or on that ship, provided he does not maintain bank account at such place or a ship. 10th point was cancelled, was replaced by another point. Payment made to agent, this is unimportant. Payment made by person to his agent for purchase of goods or services, on behalf of that principal, provided agent is supposed to make further payment in cash. 11th, last one, payment made to authorized dealer. Payment made by authorized dealer or money changer for purchase of foreign currency or traveler's check in a normal course of his business. This is unimportant. Questions have never come. Then 40 clause A, subclause 1, payment to non-resident without TDS, and 40 clause A, subclause 1A, payment to residents without complying with TDS. Here 100% is disallowed, here 30% is disallowed. There is a clarification what kind of defaults will attract this. So there are two defaults, please be very careful. Many people I have seen getting goofed up. First point, there are two types of default, it's either 1 or 2. First default, tax if deductible is not deducted by 31st March. Tax is not deducted, or deducted but not deposited on or before the due date of filing IT return given in section 139(1), then it will be disallowed. What does this mean? This means even if it is deposited, second condition is fulfilled. Second condition is not violated. It is deposited on or before the due date of filing IT return. But if the tax is not deducted by 31st March, then also it is a violation. Right now it will be disallowed. So I have clarified it. Many students from Inter CA have not studied this point and are not aware of this point. I don't know what's wrong with you people. So just keep it in your mind. I have seen many people committing this error. So even if the TDS is deposited on or before the due date of filing IT return, second condition is fulfilled, but first condition was not deducted by 31st March of the relevant year, disallowance will be attracted right now. Then I have given example in the brackets, you can have a look at it. Next one is generally disallowable expenditure, section 37(1). It says any of those 5 conditions, 3 negative, 2 positive are not satisfied, then it will be generally disallowed. Government says we can't give you anything, everything and anything in writing. Whatever are covered by section 37(1), if 5 conditions or any of the 5 conditions is not satisfied, it should not be personal expenditure, it should not be capital expenditure, it should not be for any purpose which amounts to prohibition of any law or which is offense under any law, and 2 positive condition, it should have been incurred during the previous year, and last one is it should have been incurred wholly and exclusively in connection with business profession. If any of the condition not satisfied, given expenditure will be disallowed. Now the next is deemed profit. Deemed profit means a situation where the given profit is actually not a profit, not income, but it is considered as profit, it is assumed to be profit. There are 6 situations which are actually 5 plus 1 is equal to 6 situation, whereby one of them is actually not a profit but has a different treatment, 41(5). Practically there are 5 deemed profits. Number 1, 41(1). 41(1) is something which you already know about, but then also, for example, it is called recovery against deduction in any earlier previous year. It is titled as remission or cessation of any liability for which deduction is already claimed. For example, in year 1, assessee already claimed deduction for some purchases. Say this is trading cum P&L account, and assessee claimed deduction for 50 lakh rupees of goods purchased on credit. 50 lakhs is yet to be paid. Payment is yet to be made, but deduction is already claimed in year 1. Now in year 2, second year, example number A, 50 lakhs is no more payable. The person to whom the payment was to be made, he has died, he has passed away, leaving no relatives, no legal heir behind him. So I don't know whom to make payment. So ultimately payment is no more payable to anybody. Then how much is the benefit to me? If nothing is payable any further and I receive the goods worth 50 lakh rupees, then my benefit is 50 lakh. According to 41(1), 50 lakh will be chargeable to tax, whatever is a benefit. This is deduction already claimed in year 1 in any earlier year for any trading liability which has ceased to exist. This is called cessation of liability. Cessation of liability for which deduction already claimed. Or there is a reduction in the liability, that is remission. Remission means, second example, I bargained with that person, Mr. X, from whom I purchased on credit. I told him that your goods are of substandard quality. Take them back. I don't want anything. I will not pay you any amount and you take your goods back. He requested, he started pleading that sir, please take it, pay me less than 50 lakhs, lesser amount, but then please don't return it back. I said, okay, I settle it for 40 lakhs, only 40 lakh payable. Now, how much is the benefit to me in this situation? I got goods worth 50 lakhs, but I have to pay only 40 lakhs now. 10 lakhs is my benefit. When is it decided? Answer, it is decided in second year that I have to pay 40 lakh rupee. Year 1, I already claimed deduction of full 50 lakh. Then whatever is the benefit to me, I don't have to go backwards to year 1. Don't make changes in year 1. Continue as it is. Year 2, you deem it as income. Next example, say GST. Now, first two examples were of a situation where there is a cessation of a liability or a remission of a liability. Remission means reduction of a liability for which deduction already claimed. Now, say GST I already paid in year 1 and I claim deduction of 30 lakh rupees under section 37(1). GST is allowed, income tax is not allowed. Now, example number C, GST refund of 2 lakh rupees. Now, it was found out that I was supposed to pay only 28 lakh rupees. I ended up paying 30 lakh rupees. And supposing I am closing down the business, then in such situation, according to 41(1), this is the benefit which will be chargeable to tax. This is called refund. First one was cessation of liability, liability has ceased to exist. Second one was remission of liability, reduction in liability. Third one is refund. Refund, or it is called recovery. Refund or a recovery. What is refund? Refund means something which is already paid but was not found payable, therefore it is coming back to me. First two are possible. Cessation of liability or remission of liability is possible only when payment was not made but the deduction was allowed. And third one, refund or recovery, third and fourth are possible only when payment was already made. Either 30 lakh already paid and now there is a refund of 2 lakh rupees, or there is fourth example, there is a receipt of insurance compensation against loss of stock. I purchased goods worth 50 lakh rupees, I debited 50 lakh rupees, matter over, there was a fire, all goods are lost by fire and now I received insurance compensation for 50 lakh rupees. That 50 lakh is my benefit, insurance compensation received, that is called a recovery. It is taxable provided it was allowed as a deduction earlier. So, refund, recovery, remission or a cessation of a liability for which deduction was already allowed earlier, that is the key or important condition that deduction should have had been allowed. 41(2) we are already done with balancing charge in case of SLM method of depreciation. If there is a loss, then it is called terminal depreciation allowed under section 32 subsection 1 clause 1 itself. There and there only terminal depreciation. If it is asset is sold at a profit, then it is called balancing charge. Part of the profit is taxable under the PGBP and part of it, in case there is an excess profit, then part of the profit may be taxable under the capital gain. 41(3) exactly same thing with regards to asset which was acquired for scientific R&D and now it is sold. Asset acquired for scientific R&D, cost of acquisition becomes 0. We call it as actual cost. Actual cost becomes 0 because full amount is claimed as a deduction. Now, since cost has become 0, whatever price I sell it for, even if I sell it for 1 rupee, entire sale proceeds becomes my profit. Under which head taxable? So, answer taxable under the head PGBP under 41(3). Entire amount is taxable. However, if I acquired for 100 lakh rupees and I claim deduction for 100 lakh rupees under section 35, and now cost becomes 0. If I sell it for more than 100 lakh rupees, more than the original cost, then amount received above and over 100 will be taxable under the capital gain. First 100 will be taxable under the PGBP. Then recovery of bad debts. This is slightly important. Before that, I'll just show you one example for this say 41(3) sale of assets used for scientific R&D. Cost of acquisition is 100 lakh. 100 lakh. Now it is sold for 70 lakhs or sold for 180 lakh, two examples. Sold for 70 lakh, then entire 70 will be my profit, entirely taxable under PGBP. If I sell it for more than original price, more than 100, then my profit is 180, full sale proceeds. First 100 under PGBP, balance 80 will be taxable under the capital gain. Now recovery of bad debts, this is slightly important for final CA. Recovery of bad debts, first of all, what is bad debt and what is recovery of bad debt? So year 1, I showed some income, I credited some income, 50 lakh rupees and I paid tax without receiving 50 lakh rupees, I showed it as my income. Second year, I realized that the person from whom 50 lakhs is receivable, that person has passed away, leaving no relative behind him and he is not going to pay anything. Or maybe second year, I found out that the person from whom I am supposed to receive, that person has gone bankrupt, my 50 lakhs is gone, so I am allowed to claim it as a deduction under section 36 subsection 1 clause 7. Actual bad debts, we just discussed sometimes back only. Actual bad debts is allowed provided I write it off in my books of accounts. I don't need to prove it to anybody that the debt has become bad. I don't need to prove that. I don't need to lodge a police complaint. I don't need to issue legal notice. I can claim. Now in the 5th year, after a gap of 3 years, the person from whom I was supposed to receive 50 lakh, he has contacted me back that he has won some lottery amount and he is ready to discharge his outstanding debt 50 lakh rupees without interest. I said okay. Now in the 5th year, so I showed 50 lakhs as income, I paid tax on it, then I reversed it in year 2. So now everything is squared off. Now the position is square 0. Now in the 5th year, there is a recovery of bad debt of 50 lakh rupees. So how much will be taxable under section 41(4) as a recovery of bad debt? Answer, entire 50 lakh will be taxable. But if there is a recovery of only 42 lakhs, then answer 42 lakh will be taxable. Then 42 lakh will be taxable. But if I bring a twist in the example, understand very carefully, this is not from CA final stage, this is from inter CA. Everyone knows whatever is received, whatever is realized, that much amount will be taxable. This is subject to condition that full 50 was allowed as a deduction. I claim 50, I showed income of 50, I claim 50 lakh bad debts, deduction allowed 50 lakh. If I showed 50 lakh as income, in year 1, I added 50 lakh rupees, but in year 2, AO did not allow me full 50 lakh rupees. Out of 50 lakh rupees, AO allowed me deduction of only 42 lakh. That means I paid tax on 50 lakh. Out of that, I could reverse 42 lakh. That means even after claiming bad debt, I ended up paying tax on 8 lakh rupees without receiving 8 lakh rupees. I ended up paying tax on this 8 lakh rupees. Now, if I recover anything, how much will be taxable? So, this is the example. 50 lakh I already paid as tax. 42 lakhs allowed by AO to me, though I claim 50 lakh rupees, and now there is a recovery of 50 lakh rupees. Now, if there is a recovery of 50 lakh rupees, then how much should be taxable? Answer, then taxable amount cannot be full 50 lakh. Taxable amount will be 42 lakh, whatever was allowed by AO as a deduction. Out of 50 lakh, whatever amount is received, first 8 lakh rupees, that is 50 on which I paid tax, less 42 I could reverse, 8 lakh I have already paid tax. That much amount cannot be taxed again. That 8 lakh is already taxed earlier. Now that 8 lakhs cannot be taxed again. Therefore, now what will be taxable will be only 42 lakh. But understand very carefully, this is still manageable. So how much will be taxable? Taxable amount will be equal to amount of bad debts recovered 50 lakh rupees minus amount of bad debts which was not allowed as a deduction by AO earlier. How much deduction AO did not allow? Answer, he did not allow me deduction for 8 lakhs. That means something on which I paid the tax. I claim 50 lakh rupees, he allowed me 42 lakhs AO. That means he did not allow me 8 lakh rupees. That means that 8 lakh I have already paid tax on, cannot be taxed again. Therefore, amount taxable should be 42. Continuing with the example, instead of 50 lakh, now I recovered only 44 lakhs. If I recovered 44 lakhs, how much should be taxable? So answer, taxable amount will not be 44, cannot be even 42 also, cannot be 50 also. Amount taxable will be 44 minus whatever I have already paid tax on. Amount taxable now will be only 36. FIFO method will be applied. Whatever amount AO disallowed me in that year, or rather whatever amount I already paid tax in that second year, that much to be reduced now. So amount of bad debts recovered is 44 lakhs. Out of 44 lakhs, whatever was not allowed by AO, 8 lakhs was not allowed by AO. That means on which I already paid tax, 36 lakhs will be taxable now. Are you clear? Keep it in your mind in case you want to take a screenshot. You can pause the video, do the needful. I think you should take a screenshot of this slide rather. Okay. Now, however, now one small example illustration just for the sake of your knowledge. So this is the explanation why 8 lakh should be reduced. Why 8 lakh is already taxed and that 8 lakh should be reduced. Okay. Now suppose if I recover 50 lakh rupees, then 8 lakh will be allowed. If I recover 42 lakh rupees, 8 lakh will be allowed. If I recover 44 lakh rupees, 8 lakh will be allowed as a deduction, only balance taxable. What I recover exactly 8 lakhs? If I recover exactly 8 lakhs, nothing would be taxed and nothing will happen. But if I recover less than what was disallowed by AO, if I recover 6 lakh rupees, then minus 8 lakh, now what will happen? Nothing will be taxable, taxability will be 0, under 41(4) nothing will be taxable. But now it is confirmed that my bad debts is, since I have recovered 6 lakh rupees, therefore my bad debts is 44 lakh rupees, AO has allowed me 42 lakh rupees, balance 2 lakh rupee AO will now have to allow me. Now in the 5th year, I will get deduction under section 36 subsection 1 clause 7 of furthermore 2 lakh rupees. Keep it in your mind. So, if bad debts claimed is 50 lakh rupees but AO allowed me 42 lakh rupees, so deduction not allowed by AO is 8 lakh rupees. Now if I recover, now the amount recovered is 9 lakh rupees, then amount taxable will be 9 minus 8, 1 lakh will be taxable. If I recover 10 lakhs, then 10 minus 8, 2 lakhs will be taxable. If I recover 20 lakh rupees, 20 minus 8, 12 lakh will be taxable. If I recover exactly 8, nothing would be taxable and no deduction. But in the first 3 situations, understand, if I recover only 5 lakhs as compared to disallowed amount of 8 lakhs on which I already paid tax, I will get further deduction of 3 lakhs. Here I will get further deduction of 2 lakh. Here I will get further deduction of 1 lakh. Are you getting this point? This is important. Under which section? Under section 36 subsection 1 clause 7. Keep it in your mind. This is slightly important. This can come in the form of MCQ at CA final stage. Okay, next is 41(4)(a) that we are already done with. Amount withdrawn from special reserve account. Special reserve account referred to in section 36 subsection 1 clause 8, where the deduction was least of the 3. Amount actually transferred to special reserve account, 20% of profit from such activities of providing long-term finance for industrial development, agricultural development, infrastructural development or housing development in India. Amount actually transferred, or 20% of profit from such activity, or 200% of paid up share capital plus closing balance of general reserve minus opening balance of special reserve account. And 41(5), as I mentioned here, 5 plus 1, 6. 41(5) is the last one, which is actually not a deemed profit, it is actually adjustment of loss. This here nothing will be taxable, but some set off will be allowed. So this is technically not a profit. It is not a deemed profit. So let us try to understand this with the help of an example. It says adjustment of loss of the year of discontinuation of business profession. Loss of the year in which business profession is discontinued, against setting it off against taxable deemed profit under section 41, even after expiry of the allowable period of 8 years or 4 years. Whatever normal period of allowability of carry forward is given in the act, 8 years normally, even if that period is already over, loss should have already lapsed. Then also, if it is a loss of the year of discontinuation of business, of the year of discontinuation of business profession, that loss only of that year, the year in which business profession is discontinued, loss of that year will be allowed to be carried forward and set off in this manner. For example, year of discontinuation of business profession is 13-14. In that year, there is a fresh loss of 40 lakh rupees. This is the fresh loss of the year of discontinuation of business profession. Last, it could be carried forward till 21-22, 8 years. So now in the current year 24-25, such loss has already expired, already lapsed. But now in current year, there is a deemed profit under 41(1), 3, 4 or 4A. Only one thing is not covered, 41(2), except of 41(2), which is balancing charge in case of SLM method depreciation. 42 lakh rupees of profit is taxable. This 40 lakh will be allowed to be set off against this 42 lakh, even though time period has already expired. And accordingly, only 2 lakh will be taxable. This is not deemed profit under 41(4)(a). Under 41(5), it is adjustment of loss. In case you want to take a screenshot, you can kindly pause the video, do the needful. Okay. Now, miscellaneous provision. So, technically, chapter is over. Now, what is left is the third part of the chapter, where we will be discussing about maintenance of books of accounts documents, tax audit, presumptive taxation schemes, and some other provisions. Not all of them are important. In fact, none of them are important except for presumptive taxation. But starting with section 44AA, which talks about compulsory maintenance of books of account documents. Section 44AA is divided into 2 parts, subsection 1, subsection 2. Subsection 1 applies to notified profession, 11 notified profession. Profession of accountancy, medicine, engineering, interior decoration, information technology, company secretary, representative associate, etc. 11 notified professions are those professions who are eligible to opt for 44 ADA presumptive taxation scheme. Okay, when are these people required to maintain books of accounts compulsorily? If the gross receipts from profession in all the last 3 preceding previous year, all the last 3 years, gross receipt from profession exceeded 1,50,000 rupees, 1,50,000 rupees in all the 3 years, then they are required to maintain books of accounts documents compulsorily. Or if this is the first year, then the gross receipt for the current year are likely to exceed 1,50,000 in case of first year, in case of newly set up profession. What books of accounts documents they have to maintain? They have to maintain ABCD, 5 types of books of accounts. For these people, notified profession, it is given in the act what kind of books of accounts documents they have to maintain. But the subsection 2, which applies to businesses and non-notified professions, here it is not clarified what books of accounts documents to be maintained. Assessee can maintain anything, P&L account, cash account, capital account, balance sheet, whatever he wants to. Here, these people have to maintain cash book, journal, if mercantile system is followed, ledger, carbon copies of bills exceeding 25 rupees and original copies of bills exceeding 50 rupees. I don't think so anybody maintains this. In case if assessee is a medical practitioner, doctor or nurse, etc., then they have to maintain 2 extra items. Ideally doctor, any kind of doctor, Unani, Ayurvedic, homeopathic, allopathic. Then daily case register in form number 3C and record of opening and closing stock of medicines and other consumables like cotton pad, injections, syringes, etc. Which is not so relevant. I don't think so institute will ever ask question on all these things, which is pointless. This is the inter-CA level point. Those who are carrying on business or non-notified profession, that is other than these 11 profession, they have to maintain books of accounts documents only if either of the 4 conditions are satisfied. 1, 2, 3 and 4. It is or, 1 or 2 or 3 or 4. Or. Right? So just be careful about it. Okay, first condition is with regards to income. Second condition is with regards to sales, gross receipt, turnover, and then third and fourth are for presumptive taxation people, which we will be discussing. Either practically 1 or 2 are satisfied, then books of accounts documents are required to be maintained. Which 2 condition? Understand, for professional people, 11 notified profession, gross receipt for all the last 3 years exceeded 1,50,000 from the profession, then they have to maintain books of accounts documents compulsory. Let me warn you before we proceed further that books of accounts documents are required to be maintained only by those people who are carrying on business or profession. Books of accounts documents are not mandatory for those people who are not having PGBP income at all. Those who are earning salary income or salary plus IFHP, IFOS, capital gain, not having PGBP income, then books of accounts documents are not required. Okay, either for non-specified business professions or non-notified professions or for business class people, if the income from business profession, not the total income from the given business or given profession exceeds in any of the last 3 years, as compared to all the last 3 years for notified professionals. Here the language is in any of the last 3 preceding previous year. If the assessee is individual HUF, then the income exceeds 2,50,000 in any of the last 3 years, in case if assessee is individual HUF. But if assessee is other than individual HUF, then the income from business or profession exceeds rupees 1,20,000. Second, or either 1 or 2. Second is with regards to gross receipt, sales or turnover from such business profession in any of the last 3 immediately preceding previous year has exceeded 25 lakh rupees in case if assessee is individual HUF, or the gross receipt, sales, turnover has exceeded 10 lakh rupees in case if assessee is other than individual HUF, but remember, in any of the last 3 years as compared to notified professional people where it should be gross receipt of all the last 3 previous years. Or assessee is covered by presumptive taxation scheme of 44 AE, that is transporters, or 44 BB, triple B, that is for non-residents and foreign companies which are engaged in the business of, what is 44 BB? Engaged in the business of providing facility services or providing plant machinery on hire for prospecting for extraction of or production of minerals. And 44 triple B, those foreign companies, which is only for foreign company, not for other non-residents. 44 triple B, business of setting up, or you can say erection of plant machinery or commissioning, testing of plant machinery or civil construction in connection with a turnkey power project approved by central government. both the places income will be deemed to be 10% of the gross receipts attributable to Indian operation. Income is 10%. If they are declaring actual income and the actual income is less than presumed income, then they will have to maintain books of accounts compulsorily, and not only maintain books of accounts compulsorily, they will have to get the books of accounts audited also, which we will discuss in the next section. And those who are covered by section 44 AD subsection 4. 44 AD subsection 4 means a person who is eligible for 44 AD and is passing through the lockout period under 44 AD subsection 4. What is lockout period, which we will be discussing in some time when we come to 44 AD, and is declaring actual income to be less than presumed income and his total income is greater than basic exemption limit. So what is the difference between third point and the fourth point? Both are applicable in similar situation. Assessee is eligible for presumptive taxation scheme and he wants to declare actual income and the actual income is less than presumed income under given section. But in 44 AD subsection 4, there is an extra condition: total income should exceed basic exemption. Then only books of accounts are required to be maintained. If the total income is less than basic exemption, then this condition does not apply. So he wants to declare actual income. Second condition is actual income is less than presumed income plus his actual income is, total income is greater than basic exemption, then books of accounts will have to be maintained. Then shall maintain such books of account document which would enable AO to compute the income. Any books of account, P&L, balance sheet, anything. 3 points with regards to books of account documents which are not so relevant from exam perspective. How many years of books of accounts are required to be maintained? Answer: for a period of 6 years from the end of the relevant assessment year. That means 7 years from the end of the relevant previous year, or including previous year, including the current previous year, it will be 8 years. Where to maintain? Answer: to be maintained at the place of carrying on business profession, and if carrying on business profession in more than one place, then to be maintained at head office. Unless separate set of books of accounts are maintained for each branch separately, then it's okay. Otherwise, to be maintained at principal place of business profession, that is head office. 25,000 rupees of penalty is leviable under section 271A, 25,000 flat, for failure to maintain books of account document for a period of 8 years or 6 years from the end of the relevant assessment year. 44AB, very important, audit of books of account. As far as 44AA was concerned, it was subsection 1, subsection 2, dividing assessee into two categories: carrying on notified profession and carrying on non-notified profession or business. Here in 44AB, there is no such bifurcation. Straight away, clause A, clause B, C, D, E. A, B, C, D, E, 5 clauses are there. There is no subsection, nothing doing. Of course, there is a differentiation between business and profession, but not in the form of subsection 1, subsection 2. It is everything combined together in the form of clause A, B, C, D, E. Clause A is the most important, which is applicable for business class people. Clause B is applicable to those who are carrying on profession. So I am starting with clause B. Those who are carrying on profession, if the gross receipt from profession, whether notified profession or a non-notified profession, then gross receipt from profession exceed 50 lakh rupees, then books of accounts documents will have to be audited by a chartered accountant. As far as business is concerned, if the sales gross receipt turnover from the business exceed rupees 1 crore, that is 100 lakh, then books of accounts will have to be audited. For profession, 50 lakhs, gross receipt from profession 50 lakh, business turnover exceeding 1 crore in the current previous year. However, for business class people, Nirmala Sitharamanji gave a very big gift. She said an amendment made, proviso 1 and proviso 2. Proviso 1 says that instead of 1 crore, the limit will be 10 crore rupees. Audit will be attracted only when gross receipt turnover from business exceed rupees 10 crore instead of 1 crore. No changes made for professional people. For professional people, it is still 50 lakhs only, whether conditions are satisfied or not satisfied. Only for business, it will become 10 crore instead of 1 crore if two conditions are satisfied. Number one, both are with regards to cash transaction. It says out of total receipts, including turnover, including gross receipt from business profession, the total receipts of the current year, out of total receipt, cash receipts should not exceed 5%. Cash receipts during the year do not exceed 5% of the total of all receipts. All receipts, including amount received as sales, turnover, gross receipt, all receipt will include not only business receipt or professional receipt, all receipts will include even maturity proceeds of any fixed deposit, even it will include sale consideration of any asset sold. Total receipt will include each and every item, of course pertaining to business profession, not pertaining to personal expenditure or personal purpose. Okay, total of all receipts, out of them cash receipt should not exceed 5%. Same way for payment, out of total payments, out of total payments, including payment for expenditure for business profession, not profession, business. Out of total expenditure, cash expenditure do not exceed or cash payment do not exceed 5% of the total of all the payments, including amount given as a loan to somebody. Simply, instead of payment, I would use the word outflow. Out of total outflow in the current year, not more than 5% should be by way of cash. However, Nirmala Sitharamanji accidentally used the word cash, but she wanted to say otherwise by way of account payee check, account payee draft, ECS or prescribed electronic mode. So she clarified it by way of proviso 2 rather than changing the language in proviso 1. She inserted proviso 2 stating that if the payment or receipt is by way of check or a draft which is not an account payee, then it shall be deemed to be payment made or received in cash. Simply, it should be by way of account payee check, account payee draft, then it's fine. Minimum 95% should be by way of account payee check, account payee draft, ECS or prescribed electronic mode. Otherwise, limit will be 10 crore. Otherwise, 1 crore limit. If conditions are satisfied, then 10 crore limit for audit. Turnover exceeds 10 crore, then only audit will be attracted. We have a separate chapter introduced by our institute on this called tax audit and ethical compliances, which I have covered after this. So please see that particular video also, where I have covered other points also, in what form number the audit should be, audit report. That chapter is from a chartered accountant's point of view. Right now we are discussing from assessee's point of view. That was 44AB clause A. But mind you, whatever exception is introduced, 1 crore becomes 10 crore, that is only for business class people covered by clause A. Not applicable for professional people covered by clause B, where the professional gross receive exceed 50 lakh rupees, that's it, audit will be attracted. C, D and E are applicable for presumptive taxation people. 3 types of presumptive taxation scheme where assessee declares actual income instead of presumed income, and the actual income is less than presumed income, then tax audit will be mandatory. In what situation? Number 1, assessee covered by section 44AE, transporter, 44BB, non-residents or foreign company engaged in the business of supplying plant machinery on hire or providing services in connection with prospecting for extraction of or production of mineral oil, or 44BBB, only foreign company engaged in the business of civil construction or erection of plant machinery or testing commissioning of plant machinery in connection with a turnkey power project approved by central government, declaring his actual income to be less than presumed income, or assessee covered by 44ADA, professional people, 11 notified professional, and declaring actual income to be less than presumed income and the total income exceeds basic exemption. So for clause number D, there is this extra condition that actual income is less than presumed income, that is okay, but there is extra condition that total income exceeds basic exemption. That condition was not there in clause C. Now clause E, assessee covered by 44AD subsection 4, that is business class person where the income is 8% or 6% of turnover, declaring his actual income to be less than presumed income and the total income exceeds basic exemption. Here also total income should exceed basic exemption. So clause number D and E are on the parallel lines. It's just that clause number D is applicable to notified professional people and clause number E is applicable to business class people. For both of them, common point is that the total income should exceed basic exemption. That's a common point as compared to clause number C. Okay. Now coming back here, so those who are covered by 44AD and whether they are required to maintain books of accounts or not. Answer, they are required to maintain books of accounts under point number 4 if they declare income to be less than presumed income when the lockout period is going on and the total income exceeds basic exemption. Same condition is for audit also, same condition for maintenance of books of accounts. But as far as notified professional people covered by 44ADA are covered, understand very carefully, 44ADA, then whether they are required to maintain books of accounts or not and whether they are required to get books of accounts audited or not. The answer for them, maintaining books of accounts will be mandatory. There is no exception for them. If you observe the type of exemption which we studied in point number 4 here, which is applicable for 44AD subsection 4 business class people, similar exception does not find a place in 44AA subsection 1. Here there is no exception. If the gross receipt exceeds 1,50,000 rupees, then books of accounts have to be maintained by 11 notified professionals. If they want to declare actual income which is less than presumed income, then they will have to get books of accounts audited. Otherwise, audit is not applicable. But books of accounts they will have to maintain for sure, mandatory. No audit required if person is declaring income as per 44 AD subsection 1, 6%, 8% or 44 ADA 1, which is 50% of professional gross receipt. Audit report of CA in form number 3 CD, form number not to be remembered, to be submitted 1 month before the due date of filing IT return. Due date for audit people will become 31st October of the assessment year. 1 month before 31st October will be 30th September, you know pretty well. B and C point, turnover of share broker shall not include turnover of his clients, and turnover from F&O transaction will be equal to absolute amount of profit plus absolute amount of loss from such transaction. What is absolute amount of profit and absolute amount of loss? So from F&O transaction, if assessee made, he entered into transactions worth 20 crore rupees, for which he had to pay margin money. 20 crore is the buying and selling, but he has to pay margin money of 2 crore rupees. He does not have to pay 20 crore rupees. 2 crore rupees margin money. From that, at the end of the year, he made total profit. He made a profit of, let's say, 202 lakh, and he made a loss of 198 lakh from some other transaction. Eventually, he made a profit of 4 lakh rupees. 4 lakh rupees net profit he made at the end of the year. How much will be his turnover? Answer, turnover will be absolute amount of profit 202 lakhs, absolute amount of loss, absolute amount means loss converted into positive figure, total will be 400 lakh. 400 lakhs is his turnover. And now you decide if 1 crore limit is applicable, then he has to get his books of accounts audited, and if 10 crore limit is applicable, then he has not to get his books of accounts audited. 43A is unimportant, 43AA is also unimportant, 43C is also unimportant, totally unimportant. With this we discussed in detail in the regular class with examples, but totally unimportant. If you want to glance through them, you can read them, otherwise unimportant. 43CA is important point. 43CA similar to section 50C of capital gain chapter, where assessee sells land, building or land plus building, immovable property, not as a capital asset. If he sells it as a capital asset, then 50C of capital gain chapter will apply. If assessee sells land, building, land plus building as a stock in trade, not as a capital asset, for which kind of people could it have been a stock in trade? It could have been stock in trade for builders, property construction company, etc., property developers. Then in such situation, consideration for transfer will be higher of the following two. Either it will be actual consideration or stamp duty value, whichever is higher. Stamp duty value as on what date? The answer, stamp duty value as on the date of agreement, as on the date of registration, as on the date of registration. Stamp duty value is to be taken into account only if the stamp duty value exceeds 110% of actual, otherwise stamp duty value to be ignored. For this I had given some example. There is actual is 100 and a stamp duty value is 108, then stamp duty value 108 does not exceed 110% of 100, therefore you ignore stamp duty value, consider only 100. If the stamp duty value is 111 or more than that and the actual is 100, then you consider higher of the two. Higher of the two will be taken into account as a ultimate consideration. Stamp duty value as on what date? So answer, as on the date of registration, which is a later date. Instead of date of registration, one can take into account stamp duty value as on earlier date, as on the date of agreement. One can take into account stamp duty value as on the date of agreement, provided some amount was received, part of the consideration was received by assessee on or before the date of agreement by way of account payee check, account payee draft or ECS through a bank or prescribed electronic mode, otherwise not. Otherwise, by default, stamp duty value as on the date of registration. This is an important section, keep it in your mind. The next is section 43CB, read with ICDS 3. It talks about how to compute income, business income from construction contract. Construction contract means contract of constructing some asset, including destruction of some asset and reconstructing some other asset, or contract for providing services. Two types of contract, either construction contract or contract for providing services. Income shall be computed under percentage completion method. Percentage completion means how much of the contract is completed. Based on that much revenue from contract will be taken into account. Income from contract for providing services will be income from services, service contract. Service contract, again same thing, percentage completion method. However, if the contract is for service contract is for less than or equal to 90 days, up to 90 days, duration of up to 90 days, then you don't follow percentage completion, you straight away follow project completion. Project completion method means whenever the project is entirely completed, in that year you offer entire income to tax from that particular contract. Entire income will be offered to tax only in one single year, the year in which entire project is completed, provided duration is up to 90 days. Same thing is given in ICDS 3 also, exactly same time period. Second, in case if the contract involves indeterminate number of acts, the number of acts or number of actions are unlimited or indeterminate. We don't know how many actions will be there, but the duration of the contract is known to us. Then you follow SLM method, straight line method. The contract is for 36 months, then divide income equally amongst 36 months. Then there is some note, but before that, let me show you this. So, percentage completion method is to be followed as per ICDS 3, which we covered in ICDS 3 also. As per ICDS 3, by having reference to how much income should be offered to tax, so answer that much income by giving reference to stage of completion of contract activity. This is called percentage completion method. Three possibilities: stage of completion of contract, how much contract is completed, that you find out either based on proportionate contract cost incurred, based on cost incurred up to the reporting date. Say out of total 100 crore of cost, if 32 crore of cost is already incurred as on 31st March as on the reporting date, then 32% contract is completed. Out of total revenue, expected revenue, say revenue expected is 250 crore and expected contract cost is 100 crore. So 150 crore of profit is expected, then out of 150 crore, right now you offer to tax 32% of 150 crore. That is percentage completion method. This is applicable in case of construction contract, having regard to percentage of cost incurred or having regard to survey of work performed. Survey of work performed means surveyor will have to be appointed, professional person who will come to the site, he will verify, and through some pre-decided methodology, he will prepare a report clarifying the percentage of completion of work. And third one is based on physical proportion of work. Physical proportion of work, for example, 20-storied building is to be constructed. Out of 20-storied building, as on the reporting date 31st March, 5 floors are completed, construction is completed. That means what percentage is completed? Answer: 25% is completed. Then 25% of the revenue will be offered to tax out of total 150 crore rupees. And then Proviso 243 CB says that duration is not more than, this is for service contract. This is only for service contract. Then project completion method, and if indeterminate number of acts over a specific period of time period is known to us, then follow SLM method. That is, for example, if the project is for 36 months, duration is known to us, but we don't know how many acts will be required. So we can't find out what percentage is completed. We don't know. We can't calculate also because there are indeterminate number of acts. Then you follow straight line method. Total income, say total profit expected is 150 crore. 150 crore divided by 36 months. And that way you offer it to tax. Okay. There are 2 points. Contract revenue shall include retention money also. What is retention money? So person who was given you contract may not pay 100% immediately upon completion of contract. He may retain some funds. He may retain some money. He will not pay you entire amount of the bill or invoice. He will pay you say 90%. 10% he retains, 10% will be released only upon completion of some condition or only upon satisfaction of the product, satisfaction of the contract. So right now that it shall include that also. Say for example 250 crore is the contract revenue decided minus 10%, 25 crore is retained by the payer. He pays right now only 225 crore. Then also you take into account full 250 crore. Contract revenue will include retention money also, and contract costs shall not be reduced by incidental income like interest, dividend, capital gain. These incomes, side incomes from the contract revenue, if it is earned, then that much shall be offered to tax separately under IFOS, income from other source, or under the capital gain, but should not be reduced from the contract cost. Should not even be added to the contract revenue. Neither added to the contract revenue, don't even subtract it from contract cost. Offer it to tax separately, that is what it wants to say. 43D is unimportant, but there is some small amendment from AY 25-26. It says interest on bad and doubtful debts. Interest on bad and doubtful debts, when should it be offered to tax? When should it be taxed? So interest on bad and doubtful debts, from banking industry language, we call it as interest on NPA, non-performing asset, which is like interest recoverable from Vijay Mallya, Mehul Choksi, such kind of people who are absconding from the country. In such situation, such interest is never going to be received, but as per RBI norms, these people are required to pass accounting entry in their books of account, banks. So for scheduled banks, public financial institutions, state financial institutions, state industrial investment corporation, notified NBFC, there is one more item, public companies registered with National Housing Bank, but that is deleted with effect from AY 25-26. So now only scheduled banks till notified NBFC, these people will have to offer to tax that interest on NPA, interest on bad and doubtful debts, either in the year in which it is credited to P&L account or the year in which it is actually received, whichever is earlier. So even if they are very sure that they are not going to receive, so receipt is not going to be there, then Income Tax Department, Income Tax Finance Ministry has introduced this section long back that if you credit it, if banks credit the interest, they will have to pay tax on it. Later on, they can reverse it by way of claiming bad debts, but right now they will have to pay tax on it. Section 44 is totally unimportant, applicable for insurance company. Insurance company could be engaged into life insurance business, health insurance business, general insurance, marine insurance, fire insurance, different types of insurances. Out of them, life insurance business, income from life insurance business shall be computed. Not income from life insurance business, income to be computed from any insurance, any type of insurance to be computed as per rules given in first schedule to the Income Tax Act. And income from life insurance business so computed will be taxed as per special rate given in section 115B at the rate of 12.5%, and MAT provision will not apply to it. This is totally unimportant. Questions do not come and has not come also, will not even come also. Next is 44A. 44A is again less important, but one question had come long back. In case of trade, professional or similar associations, trade association, professional association or a similar association whose most of the incomes are exempt, but they can still have some income as taxable income and some income as exempt. So ideally, I would say that these people, trade, professional association, they have two types of sources of income. One is exempt source and another is taxable source. Exempt source, taxable source. As far as taxable source is concerned, if there is a positive income, they will have to pay tax on it. If there is a negative income, then they can claim set off or they can carry it forward. But as far as exempt source is concerned, if there is a positive income, it will not be taxable, it will have to be ignored. If there is a negative income, then negative income from exempt source will also have to be ignored. When we say source is exempt, then positive, negative, both the types of income from the exempt source totally will have to be ignored. So loss from exempt source is not allowed to be set off, nor can it be carried forward. But trade, professional and other associations covered here are the exceptions. Other similar association, in case of these people, deficit, that is loss. We don't use the word loss or profit. For profit, we will use the word surplus, and for loss, we will use the word deficit. Deficit from exempt source will be allowed to be set off against profit from taxable source will be allowed, but to a limited extent, to the extent of 50% of profit from taxable source. Even though loss from exempt source should have ideally lapsed, then also for these people it will be allowed. Why questions don't come on this regularly, or questions, only one question has come, that too long back, for a reason. Here Income Tax Act is not very clear about what kind of trade, professional or similar association they are talking about. Nothing is clarified what kind of association they are talking about. So nobody knows who is eligible for this and who is not eligible to. So 44A becomes redundant, but it can come in the form of MCQ, because our institute, as far as our institute is concerned, it doesn't matter to them whether it is real life, whether a particular provision has a real life applicability or not. They can ask. Example, income from one source is exempt, then loss from the same source is not allowed to be set off. This is the normal provision. Such loss should lapse, but 44AA is an exception. It says trade, professional or similar association, they have two sources. One is exempt source, second is taxable source. From taxable source, they have a positive income which is taxable. From exempt source, they have a negative income, 8 lakh. This 8 lakh should have ideally lapsed, but instead of lapsing it, it is allowed to be set off against this positive income. Negative 8 lakh can be set off, but not entirely, restricted to 50% of this positive income. 50% of positive income is 6 lakhs. So 8 lakhs will be allowed, restricted to 6 lakhs. What will happen to balance 2 lakhs? That is not clarified. So ideally it will lapse, cannot be carried forward. 12 lakhs minus 6 lakhs, 6 lakhs will be taxable, balance 2 lakhs will lapse, restricted to 50% of 12 lakhs. In the absence of any clarification regarding carrying forward of the balance deficit, such balance deficit of 2 lakh rupees will lapse. Okay. Then 44C, head office expenditure. This is interesting. This we will be repeating once again in a chapter on international taxation, because this pertains to head office outside India, expenditure of head office outside India, meaning thereby branch is in India, head office is outside India. Assessee could be anybody, foreign company, individual HUF, non-resident individual HUF. In case of non-residents, deduction of expenses of head office outside India, whatever is allocated to Indian branch, the total expenditure outside India is this much, out of this much expenditure, Indian branch will have to bear this much. Some part is attributed to Indian business, then lower of the two will be allowed as a deduction from taxable income in India, either actual head office expenditure attributable to Indian operation, whatever is actually attributed, or 5% of adjusted total income. What is adjusted total income? That is also clarified. Adjusted total income means gross total income of the current year. That means before claiming chapter 6A deduction. Before claiming this deduction under 44C, because that is something we are calculating it. So the adjusted total income has to be before this deduction, plus before chapter 6A deduction, and before set off of brought forward loss and brought forward unabsorbed depreciation. Let us try to understand with the help of an example. Head office expenditure, lower of the two will be allowed, actual or 5% of adjusted total income. So let's say Google head office outside India, Google USA, and there is a branch of Google in India, and the head office expenditure is 800 crore. We are not talking about all the expenditures of head office. We are talking about only general administrative expenditure of head office outside India, which is supposingly only 80 crore out of total 800 crore. So balance 720 crore will lapse. Balance 720 crore, even if attributed to Indian branch, nothing will be allowed to the Indian branch as a deduction on account of payment to head office out of this 720 crore. Out of this 80 crore, which is general administrative expenditure, say 8 crore rupees is allocated to Indian branch, that you people bear 8 crore rupees. Then out of 8 crore, how much deduction will be allowed? So for example, income before this deduction, income of the Google India, Google branch is 100 crore, and 100 crore only is a adjusted total income, assuming it that way. Then deduction will be lower of the following two, either actual amount is 8 crore rupees allocated to Indian operations, or 5% of adjusted total income, assuming 100 crore only is the adjusted total income. Then 5% of 100 crore is equal to 5 crore, lower of the two will be 5 crore. 5 crore will be allowed as a deduction. Google branch, Indian branch will pay 8 crore, full 8 crore they can remit outside India, that is okay. Deduction under Income Tax Act, deduction will be to only of 5 crore rupees. Accordingly, 95 crore rupees will be the taxable income. In case you want to take a screenshot, you can pause the video, do the needful. Okay, now coming back here, what if the adjusted total income of the current year is negative? If it is negative, then don't take 5% of negative income, ignore it. Take average of last 3 years positive income. Take average of last 3 years. Average of last 3 years in case of loss in the current year. And out of those last 3 years, again there is a loss in any of the year, ignore that year. Say second year was a negative 80i. Then take 80i of only first year and third year divided by 2, average of those 2 years. If there was a positive income only in one of the year, take 80i of that year as the average 80i. And in none of the last 3 years there was a positive income, current year is also loss, last 3 years is also loss, then nothing will be allowed as a deduction. Then 44DA. 44DA we have already discussed in this chapter called chapter 12, special rates of tax chapter, applicable to foreign companies or a non-resident with regards to calculation of two incomes, royalty and FTS. 44DA, provided royalty and FTS is in connection with permanent establishment in India, connected with permanent establishment, that is branch in India, then in such situation, ideally royalty and FTS for non-resident and foreign company should be charged to tax as per chapter 12, gross amount should be taxed under section 115A subsection 1 clause B should be taxed at the rate of 20% plus surcharge plus health and education cess of gross amount of royalty and FTS. Royalty or FTS. However, if 44DA does not apply, then we will take this section into consideration and offer to tax gross amount of royalty FTS at 20%. Instead of that, if this section applies 44DA1, then net amount of royalty or FTS will be taxable, net amount will be taxable, but rate of tax will not be concessional tax rate of 20%, rate of tax will be 35% if it is foreign company, which was 40% till last year, now it is 35%. And if it is foreign company, then 35%, other than foreign company, then whatever is the rate applicable to them. Provided following conditions are satisfied, so deduction for expenses will be allowed. Deduction which are here, net amount will be taxable as per 44DA1. Income will be less after deduction, but tax rate will be high, 35%. And if 115A becomes applicable, then income will be more, gross amount, but tax rate will be low, 20%. Chapter 6A deduction will also be allowed. Actual expenditure incurred to earn the income will also be allowed, but no deduction will be allowed for payment to head office outside India or payment to other offices outside India except in case of reimbursement. Maintenance of books of accounts will be compulsory and tax audit will be mandatory. Audit report will have to be furnished in a particular form number not to be remembered. 44BB will not apply. Let's try to understand what exactly is this 44DA. So, for example, ABC Limited is a foreign company. It has FTS 100 lakh rupees, gross amount, expenditure incurred is 60 lakh rupees, net of expenditure, net amount is 40 lakh rupees. 100 minus 60 expenditure, net amount is 40 lakh rupees. If 115A subsection 1 clause B becomes applicable, then expenditure not allowed, full 100 lakh will be taxable at the rate of 20%. 20% as per section 115A subsection 1 clause B, tax payable will be 20 lakh plus surcharge plus health and education cess. But if 44DA1 becomes applicable, 44DA, then what will be taxable will be net income 40 lakh rupees multiplied by rate of tax. It's a foreign company, so rate of tax will be now 35% and tax payable will be 14 lakh. However, 44DA1 will be mandatory if two conditions are fulfilled, then 44DA. If conditions are not satisfied, then only 115A will be applicable. Number one, assessee as a PE in India. Secondly, FTS or royalty, the income is attributable to PE in India. What do you mean by attributable to PE in India, or we can say effectively connected with the PE in India? PE means branch. So let's try to understand. For example, X Limited Indian company, US company Google Incorporation has a branch in India. Google India, they have a branch in India. But so Google head office, Google branch in India, two Googles are there. However, we will have to see who is providing services to the customer X Limited. If the technical services are provided by Google head office and X Limited pays fees for technical service to Google head office, then 115A will be applicable even though they have a branch in India. Having a branch in India is a condition, but there is a second condition also, that FTS or royalty should be effectively connected with the branch in India. So instead of head office receiving this amount, in case if the services were provided by Google branch, they provided services and they are receiving FTS, then 44DA1 will be applicable, where net income will be taxable at normal rate. If you want to take a screenshot anywhere in between, you can always pause the video and do the needful. Okay, now the next is agricultural income and non-agricultural income, which is popularly called as aggregation of agricultural income with non-agricultural income, or it is called composite business. Three types of agricultural incomes and non-agricultural incomes are talked about. Income from growing and manufacturing of rubber, coffee, tea. As per Rule 7A, 7B and Rule 8. Three types of rules are applicable, which we will be discussing. This concept was there at inter-CS stage. Final CS stage, it is reproduced, but not that important from exam perspective. Tea, coffee, rubber. However, understand very carefully, this Rule 7, 7A, 7B and Rule 8 are applicable only and only in case where assessee is into dual business or composite business, combined business of growing of these items as well as manufacturing. If assessee is engaged only into growing of tea, coffee, rubber, then the entire income would be exempt under section 10(1). And if assessee is only into manufacturing of these products, then entire income is a business income, non-agricultural income, entire income is taxable. Problem arises when assessee has a combination of this agricultural income from growing of these products and non-agricultural income from manufacturing these products. Then actual records not to be maintained to find out how much is the agricultural income which is eligible for exemption and how much is the non-agricultural income. In order to find it out, actual records not to be maintained, things will be decided as per Rule 7A, 7B, Rule 8 and Rule 7 for other products other than tea, coffee, rubber. So as far as growing and manufacturing both of rubber is concerned, rubber is also called as centrifuge latex. Then 65% will be agricultural income which is exempt and balance 35% will be non-agricultural income. Non-agricultural income is not called as non-agricultural income. These people in the act call it as business income. So if business income word is used, don't get confused. They are talking about non-agricultural income. Actual records not to be taken into account. Logbook maintained, records maintained not to be considered, 65-35. Coffee will have two possibilities. It's a pure coffee, number A, grown and cured by the seller without mixing with anything. Pure coffee, grown as well as cured. Cured means curated or cured means manufactured. From the coffee beans are plucked, they are crushed in the machine and then pure coffee is generated. Then Rule 7B, Sub Rule 1, 75% will be agricultural income and 25% will be non-agricultural income. But apart from growing and manufacturing, apart from growing and curing, it is roasted also, grounded also or mixed with chicory by the seller. Then in such situation, 60% will be agricultural income, 40% will be the non-agricultural income. If it is tea grown and manufactured, then Rule 8 is applicable. Most of the time in exam, institute would end up asking about tea. Up till now, institute has never asked about rubber and coffee. They've always asked about tea. I don't know why, it's so favorite of institute. My favorite also, 60%, 40%. Therefore, I have kept it in bold letters, 60%, 40%. It's very simple how to remember it. I'll tell you. Simply in exam, in order to get exemption, you need 60% marks. You need 60% marks in order to get exemption. Passing marks are 40, exemption is. So I say that go with having tea. Tea is my favorite. Have a cup of tea and go for your exam. You will end up getting 60. And 40% at the max you will lose. But instead of tea, if you go with coffee or before that, apart from tea, if you carry eraser, if you carry an eraser, that is rubber, centrifuged latex, rubber, then you will end up getting 5% marks extra. You will lose only 35% so that you can correct your mistakes with the eraser. And in case you go with a coffee instead of tea, then you will end up getting 75% marks and you will lose only 25% marks if you go instead of tea, if you go having a cup of coffee, provided coffee is pure. If it is not pure coffee, if it is coffee but it is mixed with chicory etc., then you will end up getting same marks which you would have got had you consumed cup of tea, 60-40. With pure coffee you can get more marks, but with only mixed coffee you will get 60 marks as much as you would have got along with tea. Instead of this, if you have some other agricultural product other than tea, coffee, rubber, like for example somebody is into manufacturing of mango pulp, or from mango fruit he converts it into mango juice, fruity, mangola etc., or somebody is into manufacturing of strawberry jam or strawberry confectionaries. He has a strawberry garden where he grows strawberry, and after plucking the strawberry, he takes them to his own factory, crushes them, converts them into strawberry pulp, strawberry jam, etc. Then in such situation, Rule 7 is applicable, whereby what to do I will tell you. So as per Rule 7, let's try to understand. For example, if it is a strawberry. Strawberry is a product which is grown in the strawberry gardens of his own and then taken to the factory of assessee's own. Then in such situation, find out how much is the cost of growing strawberry. Cost of growing strawberry is, for example, 10 lakh rupees. And then it is shifted to factory. So the date on which it is shifted to or transferred to factory, find out how much is the FMV as on the date of transferring to factory. FMV will be deemed to be selling price. Selling price will be equal to FMV of the strawberry as on the date of transferring. Say for example, FMV is 30 lakh rupees. Then difference between 30 and 10 20 lakh rupees will be considered as agricultural income and will be exempt under section 10(1). And now in factory, what will happen is the purchase price and further cost. In factory you will have actual selling price. So actual selling price is 120 lakh rupees of the strawberry pulp or strawberry jam. Here what is sold is strawberry jam. Say selling price is 120, that which is known to us. Purchase price is missing, purchase price of strawberry. Whatever is the selling price considered for agricultural income, same one will become purchase price of strawberry in factory. And then there will be further cost of processing, sugar, factory, plant machinery, etc. And that amounts to, let's say, 50 lakh rupees. So 80 lakh rupees is the total cost which you will subtract from the selling price of strawberry. 40 lakh rupees will be considered as a non-agricultural income. Non-agri income. So here you do it on an actual basis. Here by maintaining records, the only missing thing which we are assuming is this 30 lakh rupees, whatever is the market value of the strawberry as on the date of transferring it to factory, that will become selling price here for agricultural income, and that will become purchase price here in the non-agricultural activity. This is given in rule 7. Okay, now we have presumptive taxation scheme. After this, we'll have presumptive taxation scheme, but this part I am ending here only. Presumptive taxation scheme and the remaining part we will be discussing in the next session in the part 3 of this PGBP revision. This lecture or this video we are ending here only, otherwise it will become too much for you. Thank you very much. Take care. Have a great time. Wish you all a very good luck. See you in part 3 of this PGBP chapter.